Yeah, so we are coming to do final accounts or publish accounts, which it will always be either publish account or cash flow. Okay, the preference has always been the final accounts. Okay, the preference has always been the final accounts. Also, although cash flow was examined once, but for the 5 years, the preference has always been the final account, and it is likely to be the final, or it is highly probable to be the final account again. So, because they want the student to understand the standards, the financial reporting standards very well, and the final account, the footnote is full of the standards. So the preference has always been the final account because of the standards. So we are coming to do 2 questions on final accounts, and we try to pick, if you have time, we try to pick some questions on standards. But the standards we are going to do tomorrow dawn, which you are all aware of that on the timetable tomorrow dawn, 3 a.m. to 3:30 a.m. to 6:30 a.m. We are going to be doing standards there. So we do part of the standards today, and we do more of the standards tomorrow. Okay, but we are going to be trying our best to solve 2 questions on final account today, and solve some questions on standards. Then tomorrow we finish with the standards. Then I can now.
So tomorrow is it at dawn or at 3:30?
It's done. 3:30 a.m.
That's early morning tomorrow.
Yeah, a.m. done. A.m.
Okay.
Yeah. All right. So we are coming to look at the final accounts. Okay. The final accounts, sometimes they will add a footnote to some of the items. Okay. But what you have to know is that this is just like profit or loss account. So you have your revenue, you have your cost of sales, you have your expenses and those ones. So you can also put a format there. Okay, you can put the structure there. Looking at the items, you can put the structure there. Okay, you need to have your revenue, you need to have your cost of sales, you need to have your gross profit, you need to have your administrative expenses, you need to have your distribution expenses, you need to have your finance costs, you need to have your profit before taxation. Maybe there might be some gain on asset. You can put other income there. If you don't have any other income, you put 0 there, or you put dash there and move on. Nobody's going to do anything. Okay, so you can also start with your structure. You put the items there, then you come and do workings. This one, most of the items, the revenue and those ones, you do workings for them. Okay, so sometimes it's not advisable to put it in a bracket and add. But if the items are not plenty, you can put it in bracket and add. It's not, you are not doing this for a company that you have to do what. This is examination. You are working under pressure. So if they are not plenty, if the items are not plenty, you can put it in bracket and subtract or add. That is it. But mostly it is the notes you have to do working. So it's advisable that you should do workings for those items that will be needing workings. And those that are not going to be needing workings, you just put it there. The items that most at times you will not be adjusting them, most at times is revenue, distribution costs, sometimes administrative expenses too, you might not adjust. The items that you are likely to be adjusting is cost of sales, administrative expenses, taxation, and maybe some other items. So we are going to be picking the question number 1. We don't have to go do workings before coming to do our, so we are going to be putting the structure there, which will be the good laugh. Is it good laugh or gross laugh? Okay, God lab. Okay, so we have the God Lab PLC. So we have the God Lab PLC statements of profit or loss and other comprehensive income for the year ended. Okay, so let's look at the year ended. That will be 31 December. 31 December 2022. So you have to put your revenue here. So let's put a currency sign here. So let's bring the revenue, cost of sales. Then you have your gross profits. So you can add other income if there's any, you bring it. If there's no other income, so you have your admin expenses. You have your distribution expenses. You have your finance costs. Then you have profit before taxation. So you can bring your tax expense there. Then you have profit after tax. So profit after tax, you can have some other comprehensive income there, like revaluation. There can be revaluation. So just leave a space there. Then you come to your B. The B is statement of changes in equity. So statement of changes in equity. This one you don't have to. You can bring some of the items straightforward over there, okay, because you start with the opening balances. So statement of changes in equity for the year ended. So you put your date there. Then what do? A statement of changes in equity just for the equity items. So the first one will be your stated capital, which is the share capital. Then you have retained earnings. So let me so that I can use all the space here. So that I'll have my stated capital. I'll have my retained earnings. I'll have my revaluation surplus. Then I'll have the total here. So you just put a currency sign here, the currency sign here, currency sign here. Okay. This one, if you are not asked to do a statement of changes in equity, you leave it. Okay. The final account is either statement of profit or loss and statement of financial position, or statement of profit or loss, statement of changes in equity, and statement of financial position. For the statement of changes in equity, just for the equity items. So what was their balance at the start of the year, and what is the activity that happened during the year? So this one, you can go to the trial balance and pick the items on them. So go and look for stated capital or share capital. Okay, what is the stated capital of the company?
$50,000.
Okay, so you bring your balance go down. That is the balance. That is the figure at the start. So balance go down to be 50,000. Okay, what is their retained earnings? Their retained earnings figure is what? At the start.
19,600.
Okay, so we have 19,600. Okay, you can see that this one they are using capital surplus, not revaluation. So you also change it to capital surplus. So you change this one to capital surplus. So what is the balance for the capital surplus?
10.
Okay. You can see that they are all okay. All on the credit side, it means that they are all positive balances. What will be the total? Mommy 79,600.
79,600. Yeah.
Okay. So let's come to the C. The C now will give you, okay, this place can take. So the C will now give you the statement of what? Financial position. So C, statement of financial position. You should put the name of the company there, statement of financial position, as at 31 December 2022. Okay. So we have our assets. Okay. And we have the non-current assets. Under the non-current assets, we are going to be having PPE. So you bring your PPE there. Then you can scan through the trial balance to see what will be the other item of non-current assets. Okay. So we have the freehold property, plant and equipment put together is a PPE. Okay. We have capitalized development expenditure. So development expenditure will also come there as intangible. So development expenditure will also come here. So we bring only the current value. So we go and do workings for them and bring the current value. So what again? We are having lease rentals. So there might be a right of use, the right of use of assets. Sometimes you can decide to, if it is PPE, you can add it to the PPE, okay? Or you can show it as right of use of assets. There's no problem with that. So we also have investment in equity shares. And so there might be a financial asset and other issues coming under the current, non-current asset. So leave a space like maybe three. Okay, after getting the items that you have in the statement of financial position, just leave a space like three. Just leave a space like three to move on. Okay, then we now move on to our current assets. Okay, for the current assets, you have to know that the company will always have receivables. There's no way the company will be trading on cash basis. Okay, so they are always going to be having receivables and inventory also. So you have to write your inventory, your trade receivables. So the inventory too, you might be adjusting it. Receivables too, you might be adjusting it. But you go to the footnote. If there's nothing about them, then you can just bring their figure over here as the closing balances. Then we have cash and bank or cash and cash equivalents. Okay, so we have cash in the bank or something, or cash and cash equivalents. Or if you have overdraft, then you have to send it to the other side. Then you have now equity and liabilities. So you have your equity and liabilities. So the equity and liabilities, what are you going to be having? You'll be having your stated capital. You'll be having your retained earnings. You'll be having your capital surplus. Then you move on, you might be having non-current liabilities. And then current liabilities, it is possible that you'll be having a deferred tax. So you can write the deferred tax here. So you can go through the footnotes. I said the footnote through the statement and look for the possible. So we are going to be having preference shares. Okay. We are going to be having preference shares. We also have convertible loan notes. We also have deferred tax. Okay, so you can bring those ones first. We have preference shares, convertible loan notes, and also we have deferred tax. So I've done the deferred tax already. So I will just go to preference shares. preference shares. Please, if it is irredeemable preference shares, you treat it, you bring it under the equity. Okay, if they are treated as if they are equity, because they are not redeemable. They don't have any cash obligation or at a future date, it will not be redeemable. So it is going to stay with the company forever. So it's just behaving like equity equity item. So we also have the convertible. The convertible, you have to know that you have to separate it. So we have the convertible loan notes. Okay. Then you can just leave a space and come to current liabilities. The current liabilities, you always have trade payables. So you bring your trade payables here, and you might be having current tax. Okay, you might be having current tax. So you bring the current tax here, and you leave a space and now come to your workers. So you now read the footnotes to see the figures that you'll be adjusting. So let's now take Auntie Patricia, are you there? Just read the top, then you leave the trial balance. Yeah. Then we move on to the footnotes.
Okay. God Love PLC is a manufacturing entity registered under the Ghana Companies Act 2019, Act 992, and also listed in the Ghana Stock Exchange. The company manufactures and sells detergents and edibles mainly in the Ghanaian markets. The following trial balance relates to the Prosperity PLC at 31st December 2022. Sir, please, I'm done.
Okay.
Should I read the trial balance?
No, leave that one. We are not.
Additional information. The following notes are relevant. 1. Sales revenue. Sir, please, can you scroll up?
Yeah, I'm coming.
Okay.
Okay.
Okay. Included in sales revenue is 6 million Ghana cedis, which relates to credit sales made to customers in December 2022 under sale or return agreement. The expiry date for the return of these goods is 28 February 2023. The company has charged a markup of 20% on the cost of these sales.
Okay. When do we recognize a sale?
When payment is being made.
No.
Once the transaction is recognized.
No. If you sell to someone,
recognized when the goods
okay,
they are recognized once the has been transferred to the customer, and all rights and all rewards and benefits, risks and benefits, additionally the goods have been transferred.
When the variable elements, when the time for the variable element has passed.
Okay. Okay. You are selling to me and you are telling me that I have the right to return the goods within 30 days. Okay. If you want to recognize the revenue, you have to wait for the 30 days before you say, okay, these goods has actually been sold. Okay. So whenever you sell on return basis, until the elapse of the time period, the goods will not be recognized as a sale. So this is sale on return basis. Sale is recognized when the possession of the items has been passed on to the the customer or the third party. Now you are saying that the person has the right to retain the goods. It means that the possession of the goods is not fully transferred to what? To the customer. And I can retain the goods. If I retain the goods, what will happen? The sale will not happen. Okay. Unless the question is saying that, okay, only a portion of the goods can be retained. So it means that whatever happened, you have sold a portion of that particular goods. Any items that are sold on sale on retained basis until the elapse of the time, no revenue should be recognized. But the company has recognized a revenue of 6 million. Okay, the goods are subject to a return. The goods can be returned at any time. So you just assume that the sale was not made, the goods are still with you until the expiring date, the people are not able to return the goods. Then you can go ahead to recognize revenue. It means that the goods have now been, the possession, everything around the goods has now been given to the person. The person cannot return it again. All right. So the goods have been sold in December 2022 under the sale or return agreement. The expiring date for the return of these goods is 28 February. Okay, so the people have the right to return their goods before 28 February or on 28 February. So now you cannot recognize revenue on this. So what has been done? We have to go and reverse all the transactions that have been passed on this particular item. Okay, so what we have to do is that they have recognized the revenue of, so let's have our first working, which will be revenue. Please, the workings are not done in order. So you see as per the trial balance, as per your trial balance, what is the revenue figure? Okay, sales revenue is 300,000. Okay, so 300,000. Okay, so we have 300,000 there. Okay, so it's very simple. It's something that normally happens at your workplace. You have given an item to the person can retain it 3 days. If your sales girl want to include the money in the sales, you say, no, this particular amount relates to this person that will retain the goods. So let's wait and see if the person will retain the goods before we can add the money. That is very simple. All right. So sales on return basis. Okay, that was included. So we have to come and take the 6,000 that has been included. Okay. What was the entries done for what? This is credit sales. Okay. What will be the entry? We are going to be reversing all the entries done on this transaction. So how was the sales recognized? We credit revenue and debit what?
Inventory.
No. Receivables. Okay. So
Okay.
we debit inventory and credit. We debit receivables and credit what? Revenue. Okay. Now we are reversing it. It means that revenue must be debited, receivables must be credited. So we have to go and remove the 6 million from the receivables there. So you can also go to the next one. You can bring receivables. So we can bring receivables here and now do that particular one for the receivables. So let's come to our receivables as per the trial balance. How much is for the receivables?
$43,100.
Okay, 43,100. So we are going to be taking the 6,000 from that. So 43,100. So we now have sales on return. So that will be 6,000. Okay. Okay, this is for the revenue. But what is the entry done on the inventory itself? As soon as the inventory has been sold, we are going to be removing the inventories from our books, isn't it?
Yes.
Okay. So this is the
inventory with 6,000.
Okay. Now the inventory will be removed at cost. Okay. Inventory will be removed at cost. The inventory will be removed at cost. And that particular amount will be added to cost of sales. Okay. So relating to the revenue itself, the entry will be debit your receivables because it's credit sales, and you credit your revenue. But what will be the entry relating to cost of sales or the inventory? We are going to be, the entry that was done is that they have debited cost of sales. Okay. The cost of sales will be debited at what? The cost price of the inventory. How do we calculate the cost price? You have given a information there that you can use. Okay. The company has charged a markup of 20% on cost for these sales. Okay. The 6 million is a selling price. We can apply a markup on what? On selling price or on sales. So what do we have to do? We change the markup to margin, isn't it?
Yeah, adjust it to margin.
Okay, how do we change that?
Markup to margin.
Yeah. So what will be our margin?
Margin will be what's the percentage? 20, right?
Yes, please.
20 over 120.
Okay. So if you are changing from markup to margin, you add the numerator to the denominator. But if you are changing from
Yeah.
margin to markup, you subtract the numerator.
You deduct it.
So that will be 20. So our profit element will be 20 over 120. So we can say that our cost element will be 100 over 120. Okay. So multiply by 6,000. What are we having?
5,000.
Okay. So our cost of this item is 5,000. So we are going to be crediting inventory. This was the entry that was done by them. We credit inventory. We remove the inventory also by 5,000. But we are saying that this is not a sale. So we have to reverse everything. Reversing means that we now have to come and credit inventory. We now have to come and credit inventory of the 5,000. And we now credit cost of sales of the 5,000. So we remove this. Cost of sales will be charged. What is the cost of the item sold? 5,000. That will be taken to cost of sales, and that will be net against the revenue of 6,000. So we are getting a profit of 1,000. Now, this is not a sale because the person has the right to retain the goods at a later date, and we are reporting before that time. So this particular revenue should be reversed. We have no transfer ownership, possession, risks associated with the item to the person in full. So the goods are still with us. So you have to reverse everything. So this is the entry done by them relating to the cost. We have to reverse. Reverse means that we have to now bring the inventory in, and also we also have to reduce the cost of sales by the item relating to that particular one. So from this on also, we can have workings 3, where we are going to be having our cost of sales. Then you look at cost of sales from the trial balance. As per the trial balance, what is the cost of sales?
$200,000.
Okay. So we have 200,000. That is cost of sales. So that 200,000, 5,000 supposed not to be part of it. So you look at cost of goods on return basis. That will be 5,000. Okay. So you subtract the 5,000. You have to bring the 5,000 back. The goods should be part of your inventory again. So you can, okay, let's go and see whether we have any other issue on the inventory. So if they are not plenty, let me just remove the receivables also, because I'm not sure the workings on receivables will be plenty. But since we are doing this, let's just have the inventory over here. So we have workings for, we have inventory. We come to, as per the trial balance, what is the inventory figure? As soon as you are giving cost of sales, the inventory given to you will be a closing stock. Okay. If you are giving cost of sales, the inventory given to you in the trial balance will be a closing stock. Okay. But if you are not giving cost of sales, the inventory, they will always give you opening inventory in the statement. So you can see that the inventory figure over here is at the end of the year. Okay.
Closing.
So The inventory,
20,000.
okay, the 20,000 supposed to be here, supposed to be at the debit side. Okay, so maybe the time that I was bringing the figure. So the 20,000 supposed to be here. So the inventory will be 20,000. Okay, so that will be 20,000. Then we now add the cost of item on return basis. That should be brought back. Okay, we haven't transferred the inventory to the person, so that should be returned back to our inventory. So yes, that is the first one, the first part. All goods sold on return basis, you can only recognize revenue after the expiring date of the agreement. And then the goods should be what? So if this should be on cash basis, okay, if this should be on cash basis, if this item should be on cash basis, okay, it means that we have debited our cash and we have credited our revenue. So the entry will be, you will now reverse the revenue by debiting the revenue. Then you will now treat the money that you receive from the person as a loan. Okay, the money will be treated as a loan and it will be classified as a short-term loan under current liabilities, because the person has the right to return the goods within a few months. So if the person returns the goods, we have to give his money back to him. So it will be treated as a loan, or you can add it to payables or other payables. There's no problem with that. But this is on credit basis, and the corresponding amount was in receivables. Since we are not selling, this is not a sale, we can't recognize revenue on this. We reverse every transaction that has been passed by the entity on this particular transaction. And that's what we have done right now. Okay, let's take the footnote 2.
Freehold property.
All right.
The freehold property had a remaining life of 25 years at 1st January 2022. The company's policy is to revalue its property at each year end and at 31st December 2022. It was valued at 49.5 million Ghana cedis. Ignore deferred tax on the revaluation.
Okay, so the freehold property had a useful life, had a remaining life of 25 years at January 2022. The company policy is to revalue its property at each year end, and at 31 December 2022, it was revalued at what? 49.5. Ignore deferred tax or transaction. So the time that we are doing income tax, we say that whenever the revaluation is done, the revalued amount will automatically increase the carrying value of the assets by that particular amount over the tax base. So that will be creating a deferred tax complications. So we do the deferred tax. We say you should ignore the deferred tax over here. But what do we have to do? We need to find a revaluation surplus. Okay. Freehold property, they say that this value is for a remaining useful life of what?
25 years.
Okay. When are we doing the revaluation?
December 31st.
Which is at the end of the year, isn't it? Okay.
Yes.
Yes.
So at this date, we need to know the carrying value of the freehold property in our books compared to the market value, isn't it?
By taking the community
Yes.
situations.
So you have to now look for the revaluation. Please, the working, nobody should lie to you. The workings are not done in order. We don't have, okay, workings, one should always be cost of sales. No, this is exam. This is examination. So what you cannot go and be looking for information that is on cost of sales. Please arrange your workings anyhow. They are just notes. The notes supposed not to have any other, okay, the first one should be cost of sales. The first one should be revenue. No, please, this is examination. Okay, this is examination for financial reporting. If you are doing it at your workplace, you can say, okay, let me bring the cost of sales, let me bring the revenue first, because you have all the day and all the time. Okay, so this one, what we are going to be doing is that we can move on to the revaluation. So we can calculate the revaluation surplus as the workings 5. So let's
It should be directed by the footnote.
Okay, so we have the revaluation surplus. So how do we calculate the revaluation surplus? We need to know the carrying value of the asset, isn't it? So you have your revalued amount. Okay, our revalued amount is, we are keeping 3 zeros at the top, so that will be 49,500. Is that
500, yeah.
okay? Then
Yeah.
we count to the carrying value. Please, you are using time, so don't go and be doing cost minus accumulated depreciation cost. No, you are wasting time. Okay. If we are going to calculate the depreciation, we are going to be calculating the depreciation ourselves. So what you are going to be doing over here is you have your carrying value to be 50,000 minus what? 50,000 over 25, because we are going to be using the asset for just a year before the what? Before the revaluation, because their question is stating that the freehold property had a fair value, had a remaining life of 25 years at 1st January 2022. And the value given to you over here are also at this. So freehold property at
How much is the carrying value?
the carrying value will be the 50,000 minus the
48,000.
so that will be 48,000. So this value over here is a value from January. It's not a value from the past. No, this is the revalued amount from January. So this is now their cost now. This is their cost at the start of the year. And this is having a remaining useful life of what, 25 years. So we have used the asset for 1 year before we now revalue. So that will be 48,000, isn't it?
Yes, 48.
Okay. So our revaluation surplus will be how much?
1,005.
Okay. After getting this revaluation, they are asking you to ignore the fair tax implication. Okay. After getting that revaluation, this is what you are coming to do here. So come here and have other comprehensive income. Okay, this will go to other comprehensive income. So we have other comprehensive income. After doing this, then you now have revaluation surplus or revaluation on freehold property. That will give you 1,500. Maybe you can put it there. Then let's count to, since you have this one, it means that revaluation must come here. So you have revaluation surplus for the year. That will go to capital surplus. So maybe there might be additional revaluation. So we will still be going ahead to see whether we can see another revaluation. Then we put all of them together. Then we now bring that as the revaluation surplus for the year under the capital surplus for the statement of changes in equity in the requirement B. Okay. So from this place, you can also start calculating your depreciation also. What will be the depreciation on freehold property?
2,000.
That will be 2,000. Okay.
Hello, sir.
Yeah.
Please, so I don't know. Can we do the posting whilst we are doing the calculation? I think that would have helped because I don't know whether you get my point.
No, senior, I'm not the one going to write the exam. So you have to adopt your strategy, what works for you. So that is, if what works for, this is what me I'm using to teach. This is for teaching. Okay. In the exam, someone can decide to do the workings, and before you come and even put a structure there. No. So in the exam, you just adopt what will work for you. If you do the posting, that is for you. For me, this is what I'm doing right now. Okay.
But I said, since we already have the structure, I was thinking that we'll be doing the posting alongside.
No, what figure?
That's what we are
At
doing.
least you know that.
What figure are you posting? Are you done with the revenue? You don't know what any item will be affecting the revenue again. You don't know. Okay. So you cannot post your revenue now unless you scan through to see whether there will be an effect on revenue. If there will not be any effect on revenue, then that is fine. Because I haven't read all the footnotes. So would there be an item that will be affecting revenue again? I have to read the footnote to the end before I confirm. Okay. So I don't know whether there will be an item that will be affecting receivables. I don't know. I don't know whether there will be an item that will be affecting cost of sales again. I don't know until I get to the final part of the footnote. So in the exam, you can scan to the footnote to see whether there's an item that is affecting. But for here, I'm picking it one by one. Okay.
Hello, sir.
Yes, please.
Yes. Please, can you clarify something more about the notes? The one that we calculated 100 over 120 times 6,000, the
Okay.
cost of sales.
Yeah.
Yes. I was thinking it would be 20 over 120.
That is profit.
It's the same thing. You
20
deduct
over
and
20
get.
is the profit.
You go and
Okay, you
deduct.
deduct.
Yeah.
Okay.
So now you want the amount at the end. That's why you did it like this.
Okay. Yes, thank you.
Okay. Okay. Please, the carrying value you can calculate. The only thing is that get the carrying value to be 48,000. So anyhow you want to calculate it, someone can do 50 over 25 multiplied by 24. Okay. You have used 1 year already out of the 25 years. So remaining 24 years. Every year is 2,000. So the person can multiply by 24 and get the 48,000. So we are done with that one also. So you also have to know about the depreciation. There will be a depreciation on the freehold property. That will be 2,000. Depreciation will always be added to the cost of sales. The question will tell you. Okay. So we put all the depreciation together and go and add it to the cost of sales. You can't be adding 1,111. So there will be a depreciation of 2,000 on that. Okay. That is note 2. All right. Auntie Patricia.
Yes, please.
Oh.
Right asset lease rental. On 1st January 2022, God Lab acquired an item of machinery under a lease agreement that had an implicit finance cost of 25% per annum. The lease payments 2.8 million Ghana cedis is in the trial balance. In the trial balance, represent the first annual rental paid on 31st December 2022. The lease agreement requires further annual payments of 2.8 million Ghana cedis on 31st December each year for the next 3 years, ending 31st December 2023, 2024, and 2025. The fair value of the machinery at the inception of the lease was 6,612,000 Ghana cedis and is estimated to have a useful life of 4 years. Depreciation on owned plant and equipment is calculated at 20% on reducing balance method.
All right. So this is about what? A lease, isn't it?
Yes.
Okay. So the footnote will always be a standard. The first one is IFRS 15, revenue from contract with customers. The second one is IAS 16, and the third one is IFRS 16, leases. Okay. This is what? This is a finance lease, isn't it?
Yes.
Okay. So if this is a finance lease, at the initial recognition, what do we have to do? At the date of the lease, what are the entries that we have to pass?
We have right of use. First, we have to discount the figures to get the present value.
Okay.
Then we establish right of use. But if there is any initial payment, we add it to the present value we had. Then we get right of use figure. Then we go to lease liability, which will be the discounted figure.
Okay.
Then we find if there is any interest for that period, we find it and then add it.
Okay. And what will happen to the right of use?
We depreciate it. It's an asset.
Okay. All right. So that is what you have to do. So they have not accounted for the transaction. They only recorded the what? The rentals paid. The rentals, are we paying in arrears or in advance?
No, yes.
In arrears. Okay. So the lease date is 1st January, but we are paying the first one on 31 December. The lease period is what? Is 4 years. So we have to go and discount this. So we have to recognize this initial recognition at the time that we are getting the what? The machinery, the time that we are leasing the machinery. What should be the entries that we are going to be passing in our books? We have to do that. And what will be the entries that we have to pass at the end of the year also? We are going to be doing that for them. Okay, please. forget about this fair value, okay, unless they are saying that the fair value is the same as the present value of the minimum lease payment. You always have to calculate your own right of use. The right of use is calculated as, okay, if you should have money and pay today, how much should you pay for the asset? That is the cash price of the asset. That's the amount that you are going to be paid. Is there any direct cost? The direct cost can be installation, can be delivery, can be those direct costs that we capitalize under IAS 16. That is the direct cost that they don't mention it to be installation. They don't try to qualify it to be maybe installation. They just say direct cost. So it can be the dismantling cost, it can be borrowing cost, it can be any of those costs that we capitalize under IAS 16. So we are coming to do this for them. Okay, let's do this for them. Let's leave a space here because we are coming to be calculating depreciation. So let's just start with the depreciation over here for them. So the depreciation, we can calculate the depreciation of this. Please, someone should share the FR link again on the main page. Someone was happening because where I'm going right now, I cannot touch my phone. Okay, so if someone is closer, someone will share. Okay, so the depreciation of freehold property for the year. Freehold property for the year will be 50,000 divided by 25. That will give us 2,000. So we have done that. You can straightforward come to depreciation of your depreciation of own plant and machinery. So let's do depreciation of own plant and machinery. Own plant and machinery is your own plant, not the lease one. Okay, the lease one will always be depreciated over the lease period. So plant and equipment. Okay, how are we depreciating that? The question is saying that. So let's tackle the easy ones. They say depreciation on own plant and equipment is calculated at 20% on reducing balance basis. So, okay, so let's come here. What is the cost? We go to the cost. Okay, let's go to the cost of the plant and the equipment. We are using reducing balance method, so it should always be calculated on the net book value. So what is the cost of the plant and equipment, our own plant and equipment? The cost is 76,600. Okay. What is the accumulated depreciation on that?
24,600.
So what will be the carrying value?
It will be 52,000.
52,000. So we now do 0.2 multiplied by the 52,000. Okay. What are we getting?
$10,400.
Okay, 7,000.
No, 10,400.
10,400.
10,400. Okay. So from this place, we are going to be putting our PP also together as a full value, but let's come to the lease. Okay. Let's come to the lease here. So you can write lease here. Okay. So you can, let's say lease asset. Okay. The lease asset, initial recognition, what do we do? We determine the lease liability and also the right of use. Okay. So let's determine the lease liability. Okay, the lease liability. So our lease liability. Please, we are going to be using annuity because that is the payments are.
Is it the same figure throughout?
Yeah?
Is it the same figure throughout?
Yeah, we are paying 2.8.
Yeah, 2.8.
So So you can do your lease liability also without bringing the years and all those things. So let's just calculate the lease liability here. Your lease liability, you just have your 2,800 multiplied by the annuity factor. 25% for 4 years. What are we getting?
Two 2.3616.
2 points.
3616.
There's 2.
Which one are we taking?
362.
2.362. 25%.
3616.
Okay. Someone, if you are using calculator, put this into your calculator. Three decimal places and see what you are getting.
But you said 3 years.
No, it's 4 years.
It's 4 years.
You mentioned 3 years.
No, it's 4 years.
2.362.
Okay, 2.36. I see that you used 3 years.
Okay.
No. Okay. So if you multiply, what are we getting? The lease liability.
612.5.
I'm getting 6613.6.
Yeah, confirm.
Yeah.
Six-
Yeah, 6613.6.
6613.6.
Okay.
Yeah.
6613.6. Okay. So that is our lease liability at that date. So our right of use will also be,
Sir,
yes, please.
please when you use, if you calculate it directly, you get the same as well. You get 6612.
6612.
Yeah, in
125.
the present value. If you calculate directly without using the annuity factor.
Annuity.
Okay. They are going to have allowance for all those things, but mostly they use the annuity. Okay. So they are going to have allowance for all of them. All right. But please don't pick the cost or the cash price or the fair value of the asset that will be given to you at that date. No. Your right of use will always be calculated as your present value of the lease payment or the minimal lease payment plus any initial deposit plus any direct cost. That is how you are going to be calculating it. So ignore any of this. It's just a coincidence that this is the same as what you are calculating. Okay, so whatever is given to you, please ignore. Calculate your right of use as the present value of the minimum lease payment plus any advance payment plus any direct cost. Okay, it can happen that it will be the same as this, but please calculate your right of use the way it should be calculated. So since we are using the annuity, we are having 6613.6. There's no problem with that. That will also be, we don't have any direct cost. So our right of use will also be the same as 113.6. Okay. So let's come to subsequent measurement. The subsequent measurement will be at the end of this year. How will this particular thing be? So we have the lease liability to be lease liability will now be, we have the balance at start. We have the balance at start. Okay, to be 6613.6. Then we have the finance cost. Finance cost should be 0.25 multiplied by 6613.6. What are we having?
We get 1653.4.
Okay, 1653.4. Then we now pay. We pay at the end of the year. So this year we are going to be paying the rentals. So the rental payment will be 2,800. What will be the lease liability at the close?
we get 5467.
Okay, 5467. Okay, please, if you cannot separate the 5467 into current and non-current liabilities, please just send this one to your current and non-current liabilities as the what? As the you send it to the non-current liability as the lease liability if you cannot separate it. Okay, but I'll show you the separation here so that we can show portion of it as lease liability under current assets, current liability, and also lease liability under non-current liability. Okay, let's come here. In the next year, what will be the interest that we are going to be paying? Or next year, what will be the interest that we are going to be paying next year? What will be the interest that we are paying next year?
It's going to be 1366.67.
So
Yeah,
the
sorry.
interest will be paid.
1366.7.
Okay.
1366.
Okay, the interest will be paid on this one. That will be 13.
66.8.
Okay, 1366.8. Okay, but what is the full amount that we are paying at the end of the year? What is the rental that we are paying at the end of the year?
2,800.
Okay, so 2,800. What is the portion that relates to principal? The 2,800 is for principal payments and also the interest payments. I'm having 1433.2, isn't it?
1433.2 when supply here.
Okay, so this is the principal payment. Okay, the interest is always assumed to be paid at the end of the year. The interest will be paid at the end of the year. So it means that out of the 2,800, it is this interest that will be paid at the end of the year. Principal can be assumed to be paid at the beginning of the year. So if you come here, your current liability portion of this particular amount, your current liability portion. So what you do, how do you calculate your current liability if the rentals are in arrears? If the rentals are in advance, it's just the rental that you send as current liability, because it will be paid immediately the following day of the next year. Okay. But if you are paying the rentals in arrears, ask yourself, what will be the interest that you pay in the next year? The interest is assumed to be paid at the end of the year. So if I'm paying 2,800, which is principal and interest payments, what portion is for the principal? The principal is treated as what? The current liability. So this figure, we are going to be having 133.2 as the current liability, and we have non-current liability as the difference. Please, I'm saying that if you cannot separate it, just show the full amount as non-current liability. Nobody is going to.
This one, when we are teaching, we will do this one. By exam, let's move by.
Okay. So the difference.
Because it takes more time.
The difference will be 5467 minus that one. We are having 4033.8. So from this one, go to your statement of financial position straightforward. Count your lease liability here. Count your lease liability here and have 1433.2. There will not be any issue on lease liability again. So you count the lease liability also over here, which is a non-current. You show your 4033.8. Okay. So let's do the depreciation.
But please, when you want to go by the full, you send it to non-current liability, right?
Exactly, 5467. We are good to go. All right. So we come to the depreciation of the right of use. The right of use must be depreciated. Okay. So the right of use, 6613.6 divided by 4 years. What are we having?
$1,653.4.
Okay. 1653.4. Okay, that will be a depreciation. You can go to your statement of financial position, then you show right of use of assets here as a separate item. If you want to add it to the PPE, no problem, but it will be advisable for you to show it as the right of use of assets. Okay, so right of use of assets, what will be the carrying value?
6613.
Now we have depreciated it for 1 year. So what will be the carrying value?
Four nine six zero 4960.
4960.2.
Okay. So we are done with the lease also. Please, the footnote, you cannot go to the exam without seeing footnote on leases. But for EP and the income tax, that one will come. You can also see it on financial instruments. You can also see it on revenue. You can also see it on IFC inventories. So for the final accounts, you need to master. It can also be on impairments. So you need to master some of the standard, or maybe borrowing costs. It can also be on investment property. Any you can set a question on. So you just have to be okay with all of those issues. So we are done with the right of use of assets, and we are moving to the research and development expenditure, which will be under what? Research and development expenditure.
Intangible.
Okay, it's under intangible assets. All right.
Research and development expenditure. In addition to the capitalized development expenditure of 20 million Ghana cedis, further research and development costs of 8.6 million Ghana cedis were incurred on a new project which commenced on 1st January 2022. The research stage of the new project lasted until 31st March 2022 and incurred 1.4 million Ghana cedis of costs. The remaining costs were incurred evenly over the development stage of the project. Effective from 1st June 2022, the directors became confident that the project would be successful and would yield profits well in excess of its costs. However, the project had not been completed at 31st December 2022. Capitalized development expenditure is amortized at 20% per annum using the fixed installment method.
Okay. So let's go here. You can see that there is a capitalized expenditure. There is a capitalized development expenditure of 20 million, isn't it?
Yeah.
Okay. There's a capitalized development expenditure of this one. This one is already active. We are using it. That's why we also have the accumulated depreciation on this as 6,000. Okay. But they are saying that in addition to that, there was a additional development that was done, and the amount is what?
6,000. 8,600.
8,600.
So they are giving us information on that. You can see that portion of it is for research, isn't it? And portion of it will be for development. Research expenditure, whenever it is incurred, what do?
We expense.
We expense. So what is the research amount of this particular project?
1,000.
Is it any clue to detect?
No, the research stage of the new project lasted until 31 March 2022.
Oh, okay. Okay. We use the time period to detect.
And incurred 1.4 million cost. Okay. So 1.4 million out of how many? Out of how much?
6.
So let's determine let's come to research and development expenditure. So, okay.
Working 7, right?
Yeah, 7. So we have research. You can just put, okay, some of the abbreviations are accepted. R&D. Okay, it's a widely used abbreviation. Okay, so we have research. Yes, please.
In workings or way.
So I'm still with you.
Yeah, you said some of the abbreviations are accepted, and I'm asking whether in workings or way in the face of the financial.
Anyway, since it has accepted, wherever you are putting it, it will be accepted.
Okay, thank you.
All right. So let's come to research stage. The research stage lasted up to, it will be January to March, isn't it? Is it January to March?
Yes, 31st March.
Okay. So let's come now to developments. Okay. Capitalization starts from when? The capitalization of development expenditure starts from when?
June 1st.
Capitalization of development expenditure starts from when? Not the date. What are you going to be seeing to? I'm not talking about a date. What are you going to be seeing to know that, okay, we have to start capitalizing from this date?
So when
If the research will be successful.
Okay. Okay. So when development expenditure will start, capitalization will start from the time that, for examination sake, it will start from the time that management are confident or management are convinced that the project will be successful. That is the time that we are going to start capitalizing the development expenditure. So capitalization will start from the first June here. So it means that from April to where men will still be classified as a research stage, isn't it?
Yes.
Okay. So the figure that will go to profit or loss, we still bring development over here. So we bring a development over here, and this will be calculated as what is the remaining amount after the research amount is taken. 3,600 minus 1,400. That will be 7,200. Is that correct?
Yes.
Okay. And they say this has been incurred evenly over the period. So this will be for 9 months multiplied by 2. Are we okay with that?
Please come again, multiply by 2. Why 9 multiply by 2?
Okay. I know I will surely come, so don't worry. So let me put my figure here.
Because the first 3 months is taken away, right?
Yeah.
The first 3 months of 2022. That's why it's 9.
Yeah. The 8,600 is for the full year. Okay. We have January to March. That is research stage. That is 1,400. So if you are take the 1,400, you are going to be having 7,200. And they are saying that the research stage of the new project lasted and this. The remaining costs were incurred evenly over the development stage of the project. So the development stage starts from 1st April to December. That is 9 months. And we have incurred a cost of 7,200. This cost is assumed to incur evenly over the 9 months. So every month is the same amount. Every month is the same amount. Okay. But the capitalization will start from 1st June. So it means that April and May, we will still have to expense that particular amount to profit or loss. So how do we calculate that? We do the 7,200 divided by 9. That is the amount for every month. How many months are we expensing? That will be 2 months. We multiply by 2. So I hope you're okay now. Okay. So what will be the figure that will be going to profit or loss? So the capitalized amount will be 5,600. Is that correct?
Yeah, it's correct.
Okay. So let's come to, you see, they say this project is not what? It's not completed, so we can't start amortizing it. Okay. However, the project had not been completed at 31 December 2022. So the project is still in development stage, so we can't start amortizing. But what will happen? We have a completed project already, which is 20,000. So we have to find amortization on that particular one. So amortization of the completed project. Okay. Amortization of completed project, which is in the statement of financial position. Okay. How are we charging amortization? The amortization is 20% per annum using the fixed installment method. What do they mean by the fixed installment method?
Straight line.
Okay,
Like
fixed installment is still straight line. So
straight
the
line.
amortization will be 0.2 multiplied by the 20,000. How much are we getting?
You get 4,000.
Okay, so that will be the amortization of the already capitalized development expenditure. But this one will be added to our development expenditure. Let's do the development expenditure. And now, so let's find the final value of the development expenditure, the carrying value, and now send it to our statement of financial position. So we have, so let's look at the carrying value as at this date. We have the balance brought down, which is opening balance. That will be how much? 20,000. Okay. We have accumulated amortization. What is accumulated amortization in the statement of, in the trial balance?
6,000.
Okay. So we have 6,000. So this will be subtracted. So that should be the carrying value at the beginning of the year. We still have a charge for the year now. So we still have to amortize this for the year. So this will also be opening balance. Okay. The charge for the year is 4,000. Okay. Then we have a new development. Okay, there was a new development, and that was 5,600. What will be the carrying value of the development expenditure?
15,600.
Okay. So you send this one to your statement of financial position straight away. So development expenditure, you can name it, that will be workings with. You have to be adding a
7.
okay, that will be working 7. So the leases was working 6. Okay. So this will be working 6. This will also be working 6. This will also be working 6. Okay. Whatever happened, they will go through the workings. They will read everything and mark. So if you don't add the workings and you have forgotten to add the workings, nobody's going to do anything because they will still go through the notes before marking the items. Please, the amortization, they will tell us how we are going to be treating it. The question can tell you that all depreciation and amortization will be charged to cost of sales or administrative expenses. So we are waiting to get that statement so that we can charge it to whatever we will be charging it to. Okay. Okay, so that is about that one also. Let's see. So let me look for that statement and see. Okay, they are not saying anything about that. So what will happen is, since they are not saying anything about the depreciation and amortization, depreciation will always be charged to cost of sales. So let's find the total depreciation. What will be total depreciation for, okay, total depreciation for the year will be 2,000 on the freehold property, 10,400 on plant and equipment, and what, 1653.4 on our right of use of assets. So what will be the total depreciation? Can we get that?
14,053.4.
Okay, so the depreciation, you put all of them together, 2,000 plus 10,400 plus 1653.4. Okay, that will give us 14,000.
14,053.4.
Addition or subtraction?
Addition.
Addition.
Depreciation is a cost, so you add. All right. So we are done with the depreciation now. Amortization, we take it to administrative expenses. All right. But if you charge it to the cost of sales, so there's no problem with that. Okay. So, okay, let's bring the amortization also over here. But it's always the depreciation that will be charged to. So the amortization will be 4,000. That will also be a cost. Okay. So after we have known the depreciation right now, we can go and find the value of our PPE. So let's go and find.
Hello, sir.
Yes, please.
Yeah, sorry to interrupt. Please, that depreciation, the figures, can you please help me, like, what you think that?
We have 2,000 for freehold, 10,400 for plant and equipment, and 1653.4 for right of use of assets.
Okay.
All right. So since we have done with that particular figure now, the depreciation and those ones, we can now find the carrying value of our PPE. Okay, so the carrying value of the PPE, you always start with the opening balance. So we have balance. So the balance go down. Okay, the balance go down for the PPE will be 50,000 plus what? Plus that of the plus that of plant and equipment. What are we having? What is the balance for equipment?
76,600.
Okay, 76. These are all going to be at cost. So 76,600. Okay. So if you put it together, what are we having?
You get 126,600.
126,600.
600.
Okay. Then we have accumulated depreciation. Now, let's have accumulated depreciation. So we just bring the items here. There will be a revaluation surplus of 1,500. So that will be in addition to our assets. So 1,500. Then we have accumulated depreciation at the start. That will be balanced or down. Depreciation on that is how much?
24,600.
Okay, 24,600.
24,600.
Then we come to the charge for the year. Charge for the year will be 12,400. Okay, freehold and the plant, that is 12,400. What will be our closing balance?
91,100.
91,100. Okay. I'll also show you how you can also calculate this one differently. Okay. You can also calculate this one differently like this. Okay. You can see that freehold property, the carrying value of the freehold property at the end of the year is 49,100, isn't it?
Yes.
Okay, so you just take the 49,500, that will be the carrying value at the end of the year, which is the revalued amount. Then you will now come and calculate the carrying value of only the plant and equipment. The carrying value of the plant and equipment will be calculated like this: 76,600 minus the accumulated depreciation of 24,600, 24,600, then minus the what? The charge for the year of 10,400. What are you getting?
You get 41,600.
So the carrying value of freehold is this. Then we come and add a 41,600 to it. Okay.
$91,100.
So anyhow you calculate it, you are just working with your time. So there's no problem with how you are going to be calculating this one. So let's have the 91,100. So we have the workings, maybe 3 or 4, depending on. Okay, so we have the 91,100. Okay. What was the development expenditure that we calculated? I'm sure we have calculated that 15,600. So development expenditure.
15,600.
This should come here. All right. Oh no, the capital development expenditure is in the question already. We have the question has given you this figure. Capitalized development expenditure. This is the 20,000. So this is the one that have been capitalized and the project is successful. That's why we always have the amortization. It means that they have started amortizing this. But the one that we have carried out this year, which 5,600 will be 5,600 will be 5,600 will be capitalized, is years to be completed. So we don't do anything to that particular one. Please, let's come to the
Please, research and development, the ones that you are going to expense,
I
are you
would,
going to
I
add
would,
it to your?
I will add it to administrative expenses.
So the charge for the year,
Yeah,
that's the summation of all the depreciations,
yeah,
is 2,000 plus 10,400
yeah.
plus what's
16,
the name, 16,1653.
yeah, 0.4.
Yeah, 0.4. So when I do my sum, what I'm having is 14,052. What you have there is
14,
12,400.
having 14 what? Mention that figure again.
14,053. Okay, 14,053. Okay, and 14,053. Yeah, that's what I got.
Is it 14,503 or 14,053.4?
14,053. 14053. Someone can also add and confirm.
He has omitted the 0.4.
He has included the right.
There's a 0.4 at 21,653.
So it's supposed to be 14053.4, isn't it?
Yes, sir.
Yes.
Yeah.
Okay, that is including what? Right of use, isn't it?
Yes.
Did we include the right of use in the PPE?
No.
Yes. No, we sent it separate.
No.
Okay, so that depreciation should not have any effect over here. The
Shouldn't have added
165
it.
shouldn't have any effect on the carrying value of the PPE. The depreciation relating to the PPE is only 2,000 and 10,400.
Oh, okay.
All right. So yeah, senior.
Let me see your cost of sales workings again. The amortization 4,000. Okay, I've seen what's coming from. Okay.
Yeah, senior, you were asking about the development expenditure that will be expense, isn't it? The 3,000.
Yeah.
I will add it to administrative expenses. Okay. Or if we should treat the amortization, if the amortization is going to cost of sales, then it means that this should also let's treat the amortization as part of administrative expenses so that the treatment will follow the same pattern. If you are charging amortization, it means that the development expenditure should also be, so take that 4,000 over here. Let's come to administrative expenses. So admin expenses. So the research and development expenditure will be for administrative purposes. So let's have, as per the trial balance, how much are we having? Administrative. Administrative is what?
21,100.
Okay, 21,100. So that will be 21,100. Okay, so 21,100. Add our amortization to it. That will be 4,000 because it's a cost. Then we add our research and development that's supposed to be expense. That will be 3,000. Okay. So that the treatment will be in order. Research and development is for administrative purposes. So amortization should also be treated as the part of the administrative expenses. Okay. Investment in equity shares. Auntie Patricia.
Investment in equity shares. The investment in equity instrument held at 31st December 2022 consists of 2 million ordinary shares held in Enionam PLC. The market prices per share as at 31st December 2022 was 2.2 Ghana cedis. There were acquisitions, disposals of these instruments.
It's supposed to be there were no.
Okay. There were no acquisitions or disposal of this investment during the year ended 31st December 2022. The entity made an irrevocable election at initial recognition of these instruments to recognize all changes in fair value through other comprehensive income On 18 December 2022, the directors of NNN PLC declared an interim dividend of 30 Ghana pesos per share. Dividend warrants issued, but checks were yet to be issued to the shareholders as at 31st December 2022.
Okay. So thank you. Let's go to this is what? This is going to be financial asset, isn't it? This will be a financial asset to the entity. Okay. Through other comprehensive income. Let's go to where they are having that particular investment. What is the investment? Okay, investment in equity shares. How much is it? It's 4,000. Okay. We purchased that at 4,000. Okay. So let's come to investment in equity shares. So investments in equity shares. Okay. So we have the balance as start. So balance brought down is 4,000. Okay. What is the fair value? What will be the value now? They say this is true other comprehensive income. So at the end of every year, we have to fair value this. Okay, this is equity instrument. So it's either you carry it through profit or loss, or you carry it through other comprehensive income. So what is the value per share at this date? What the value per share at the reporting date? Let's go and look at that. What's the value per share at the reporting date? The value of a share at 31 December is how much?
2.2.
Okay. So what will be if value of a share is 2.2? Then what will be the total value of the shares that we have there?
We divide it by 2.2.
No, we have number of the 2 million is number of shares there. Okay.
We multiply.
Okay.
So we have 2 million shares multiplied by 2.2. How much are we having?
4.4.
4,400.
Okay. What is happening?
It has been increased.
So let's
It's
say
a gain.
value gain,
Again,
Fair value gain.
fair value gain of 400. Where would the fair value gain go?
Other comprehensive income.
Oh, I
Okay.
see.
So you bring it to your other comprehensive income as a fair value gain on, you can say on equity investments. Okay, equity investments, and that will be, so we can have the revaluation surplus to be 1,500 now, then this will now be 400. Okay, so we can just see, so this one, what you do is that just bring other comprehensive income item here. So they are all going to be, okay, so other comprehensive income. So you bring, they are all going to be recognized in the capital surplus. So that will be 1,900. Let's go to our financial assets.
Sir, please,
Yeah.
please, can you go over just the whole thing again for me? Just the investment on the equity shares.
Oh,
which
nice.
is the-
We have, that will be the financial assets. That will be reckons 8. Then you bring the fair value at the reporting, that will be 4,400. We come to the dividend issue now, but let me take this one again. Okay. They are saying that you are buying what? You are buying, you purchase 4 million shares. You purchase 4 million what? I say 4 million, 2 million shares. Okay. The 2 million shares was purchased during the year. How much did you pay for it? You have paid 4,000 for it. Okay. The instrument is carried through other comprehensive income. So at the end of every year, you find the fair value of your investments. Okay. They are saying that at the reporting date, a value of a share is 2.2, and you are having 2 million shares. So what will be the value of the 2 million shares? It will be the 2 million multiplied by the 2.2, and you're having 4,100. Okay. And the value that you have in your trial balance, or the value that is for the investment, you have 4,000. but the fair value is now 4,400. It means that the value has increased by 400. These 400 gains supposed to go to other comprehensive income because the instrument is carried to other comprehensive income. So it's just like revaluation. Okay, let me put it. It's just like you are revaluing the investment at the end of every year. You revalue the investment at the end of every year. So at the reporting date, the value is 4,400, but you have only 4,000 as a carrying value. It has increased by 400. That 400 will go to other comprehensive income, and your investment will now be carried at 4,400 as the new balance or the new amount in your statement of financial position. All right, I saw a hand up.
Thank you. Thank you.
Yeah, Senior Leonard,
Yeah.
can you also do it in such a way that the value of the share is 4,000, and then you divide it by the number of shares, then you get a value for each share. Then you compare it to the current share price. Then you multiply by the number of shares, and then you get gain or loss that is instead for you to.
All within the 36 minutes.
I understand.
Or that is also you look for you find what is the share price. The share price will be 2 cedis at the time that we purchase it, isn't it?
Yeah.
4,000 divided by 2. Okay, the share price is now 2.2. There is an increase of 0.2 per share. So you multiply, you get a 400. Okay. But are you going to be doing this in the exam hall?
Okay.
When you need the total to send to your.
I get you.
Okay, so yes, if you are in your office, you can do it nicely for your boss to know that, okay, this guy, he really understands the standards. Okay, so that one to be outside the distance. But in the exam hall, please, let's work for the 15 marks. You come back, you can say, okay, alternatively, this can be done like this. Okay, but if you can work fast within that time, I don't have there's no problem with that.
Please,
yeah.
My problem is with the classification. So you later on after the class, I'll contact you.
No, this is equity. This is financial.
Yeah, I know the whole financial instrument.
Okay, no
I have
problem.
problem with the classification, so I will
No problem.
get
No,
back.
you ask, maybe which we have problem, then it will be solved.
No,
here.
it would delay the process here. So let's finish. When we finish, we can post it on the main platform and deliberate on.
Okay. So let's come here. On 18th December 2022, the directors of Enunam PLC declared an interim dividend of 30 pesos per share. Dividend warrants issued, but checks were yet to be issued to the shareholders as at 31 December 2022. So what is happening here? Dividend has been paid on the investment, isn't it?
Yeah.
Okay. And dividend is what? 30 pesos per share, isn't it?
Yes.
And how many shares do we have? What is the number?
200. Is it 2,000?
Okay. That will
2
be
million, yeah.
So we are keeping 3 zeros. So let's count the dividend income here. Dividend income. So the dividend income will be 0.3 multiplied by 2,000. Is that correct?
Yes, sir.
Okay. How much are we having?
600.
Okay. So this is a dividend income. Did we receive cash?
They say check.
Okay. Checks are yet to be issued. So it means that they are still owing us, isn't it?
Yes.
Okay. But this dividend is an income. What will happen is that you show the dividends as other income. That will be, so you can see that we have the other income. So please, if the instrument is classified to other comprehensive income, the income that is coming, it is a normal income that the company is having. It's an investment that they are doing. So that is an income. But it's the gain that will go to either profit or loss or the other comprehensive income. But the income, whether it is classified through profit or loss or other comprehensive income, the income is an income that will be taken to profit or loss. So the dividend that we are receiving here, the dividend has been paid during the year. It is not after reporting date issue. This has been done during the year. So we are entitled to this particular dividend. And we are going to be receiving 600. So the 600, I'm not sure there will be any other income somewhere. We come and I'll put a 600 here for now. But these people are still owing us. So we can classify that as receivables. So we can say dividends receivables. So we put it together. and have our receivables. Or you can, if it is trade receivables, you can change it to trade and other receivables. Okay, so you can add the dividend receivables of 600 to this. Okay. All right, that is for that also. Convertible notes. Hey, the person who typed this question, what's something?
Convertible loan notes. Please, can you scroll up?
Yeah, I'm going
Okay.
You omitted that portion.
Okay. All right, so I hope you can take it now.
Yes, please. The 20% convertible loan note, 5 million Ghana cedis, was issued on 1st January 2022 at its normal face value of 5 million Ghana cedis and redeemable on 31st December 2023 if not converted. Interest is payable in arrears at 31st December each year. The loan note is convertible into equity shares at the instance of the holder at any time within the loan tenure. The market coupon rate of a similar instrument that is not convertible is 25% per annum.
Okay. Okay, so this is a convertible instrument, isn't it? Okay, which will always be having a debt component and what? Equity what?
Component.
Equity component. Okay, but this one they are saying that the loan note is convertible into equity shares at the instance of the holder at any time within the what? The loan tenure. So this one, it means that the person will always ask for the what? The person can ask for the conversion or the person cannot ask for the conversion. This is the holder. You, the creditor, or you are the holder, the creditor to the entity. You have the option to convert or not. It is likely that these people are not going to be converting. But if they say that the conversion will be at the what? At the option of the company can ask them to what? To convert, or they will not ask them to convert. And the company is not going to be asking them to convert, or it will ask them to convert because we have the option. But this one, the holder has the option. So the holder, what are you going to be doing? It might happen that, okay, if the conversion is favorable to you, you will convert. But if the conversion is not favorable to you, you will not convert. Okay, so the redemption depends on what? The holder. So this will still be treated as the what? The convertible instrument. We separate it, the debt component, and we also separate the equity component. The option, please, the option, if you count redeemable shares, if they say the option is the what? The person who has the option is the issuer, which is the company. It means that the company will never ask for redemption. So that will be treated as irredeemable preference shares. But if the redemption is at the option of the holder will ask for the redemption at all costs. So this is not going to be adding any value to the footnote over here. But if it is a redeemable preference shares, okay, and the option is at the what? At the instance of the issuer, the company will never ask for the redemption. So that will be treated as irredeemable preference shares if you are calculating your earnings per share or something like that. But let's come to the convertible, 20% convertible loan note over here. This is 5,000, which is the full value. A portion of it will be for equity, and a portion of it will be for. Okay, so what we do is that we always find the debt component. Okay, how do we find the debt component? Okay, the debt component is just the present value of all the cash flows at all the cash flows relating to the instruments. So we are going to be having the years here. I will be bringing the cash flow. I'll be bringing the discount factor, and I will bring in the present value. So it will take us how many years to convert? It is for how many years? The instrument is for how many years? It is issued on 1st January, and it can be redeemable on 31 December
23.
So how many years is that?
That's 1 year.
Oh, no. No.
2.
1st January.
That's 2 years.
That is 2 years, isn't it?
Let me see.
2 years is too small.
I'm not seeing the redemption date.
No, it's redeemable on 31 December 2023, if not converted. Okay. So if it is 2024, then that will be 3 years, isn't it?
Yes.
Okay. So it means that we are going to pay interest for 3 years. So interest for 3 years. What will be the coupon? The coupon is the interest that we are paying on these instruments. So what will be the coupon amount every year?
1,000.
Okay, that will be 1,000. 0.2 multiplied by 5,000. That will be 1,000. Okay, so we have 1,000 here. Okay. We count to this one. We are looking for present value of a bond. So this is just like you calculating value of a bond. You use the what? The actual cost of what? The bond, which is the 25% over here. So we use the discount rate will always be the rate of a similar bond without what? Conversion.
Unconvertible.
Okay. So what will be the discount, the annuity factor here? Would that be 3 points?
1 point.
3 point what?
I'm getting 1.952.
25%.
3.999.
Is it 25%?
3.999.
Yeah, 25%.
3.999.
No.
Is it not annuity?
Yeah,
Yeah,
25%.
25%. So it's 1.952.
It's 1.952.
1.952.
1.952.
1.952. Okay. So in the third year, what will happen? We are going to redeem this amount by paying the par value, isn't it?
Yes, sir.
Okay. So what will be
1.9.
the discount factor of 25% in the third year?
0.512.
0.512. Okay. So the first one will be 1952 if we multiply. 1952 if we multiply, and we have 5,000 multiplied by 0.512. I'm having 2560.
560.
What will be the total?
4512.
Okay, 4512.
There is it.
Okay. So what will be the equity component?
Deduct it from the total.
Okay. So
480.
488.
Yes, sir.
So that will be 5,000. The amount that we're supposed to receive is 4512 for the debt, but we have received 5,000. So it means that the equity component is this one. Okay. What will happen to the debt component? It has to be subsequently measured at amortized cost. So it's just like financial liability. So subsequent measurements of the debt component. Okay. That will be the balance as start to be 4512. Then we now have the finance cost of 0.25 multiplied by 4512. Okay, we don't have any issue of issuing cost. If there's an issuing cost, we know how to do it. You have to share the issuing cost in the proportion based on their carrying value. So the issuing cost will now be subtracted from the debt. Then you will now use effective interest rate that will be given to you as a result of the issuing cost. We have done that so many times under financial instrument ESOP. So what are we getting as a finance cost?
1128.
Okay, 1128. At the end of the year, what will happen? We are going to be receiving the coupon. Okay,
20%.
multiplied by 5,000. The coupon will still be the 1,000. Okay. So what will be the value?
4640.
4640. Okay. So this will be our closing balance of the. So let's calculate our total finance cost. The finance costs have to be calculated. Okay. We have the finance cost for lease. What is the finance cost for lease?
$1653.4.
Okay. 1653.4. And the finance cost for the convertible instruments is 1128. So let's put the two together and send it to our
2781.4.
okay, 2781.4. That will be the finance cost in the statement of profit or loss. So we count to the finance cost. That will be workings 9 to that will be a subtraction 2781.4. Okay, let's come to our convertible instruments. The convertible instruments are supposed to be what? 46. The closing balance are supposed to be 46 what?
4640.
Okay. Equity component, there's other component of equity, isn't it?
Yes, sir.
Okay. Please, if you like, you can change the capital surplus to other reserves so that you can capture the revaluation surplus and everything over there. So other component of equity. So that will be 488, isn't it?
Yes, sir.
Okay. So you have to come and now do this one. It means that we have to add other components of equity here. But if you like, you can change the capital surplus to other reserves so that you can take the revaluation and order everything into the other reserves. You can name it other reserves so that you have your 10,000 plus. It means that you have to create a column for your other component of equity as a transaction that is happening during the year. Okay, but that is not a big deal since you have the 488, which is the other component of equity, and the finance cost also, we are now okay. So this will be the balance, and this will be equity component, and that is it. Let's go to another issue. Okay, we don't have any other issue about cost of sales and this one. So you can ignore this, your adjusting this, your footnotes. Then you can come to the revenue. Revenue will be 294,000. Is that correct?
Yes, 294.
Okay. So you can send your revenue as 294 there. So revenue will be workings 1, 294,000. Would there be any issue on cost of sales again? No. So we can go and total the cost of sales there and have our figures. So cost of sales will be what? Yeah, good.
It will be 209 053.4.
209.
053.4.
209. Okay.
24.
Okay. So let's go to 2095053.4. Okay, what will be our gross profit?
84946.6.
Okay, 8494.
6.6.
6. Okay, so our other income, I'm not sure there's any other income. So we have to, so we have done that now. So we can now, our receivables too, we need to come and look at it. Inventory, is there any other issue about inventory again? I'm not sure. So we have 25,000 on the inventory. So we can go and put the inventory there as workings for, okay, 25,000. Okay. So let's take the rest so that we can just reconcile everything. Fraud.
Fraud.
Yeah.
In December 2022, Prosperity's internal audit department discovered a fraud committed by the company's credit controller who did not return from a foreign business trip. The outcome of the fraud is that 3 million Ghana cedis of the company's trade receivables have been stolen by the credit controller and are not recoverable. Of the amount, 1 million Ghana cedis relates to the year ended 31st December 2021, and the remainder, 2 million, relates to the current year. God Lab is not insured against this fraud.
All right. Fraud is what? Fraud is adjusted. Fraud is adjusted.
Event.
Okay.
Adjusted event.
Okay, but I'm talking about the treatment. When you have fraud relating to the previous year, what do we do? It is adjusted retrospectively.
I think retrospectively, yeah.
Fraud and change in accounting policy have the same treatment. Okay. They are saying that the 3 million included in our receivables has actually been what? Been received, isn't it? Okay. Has actually been received, but what is happening is that our credit controller is chilling with the money. Okay. Out of these 3 million, 1 million relates to the prior year,
The
previous year, and the remaining one relate to the current year. Okay. Okay. We are not insured against this one. If we are insured against this one, then it means that we have to write off our receivables and now have insurance claim on this. But we are not insured. So it means that we are going to be losing all the amount. The first thing is that we have to go and reduce our receivables by
1 million.
no. Our receivables, how much is included in the receivables? The 3,000 is still included in the receivables. The money has been received, but we are thinking that the people are still owing now. So the 3,000 is still in the receivables. So the 3,000 has been received. So we have to come and cancel the receivables by 3,000. Okay. We credit.
Please question. Senior, per the statement, it was saying 1 million relates to the reporting and the other relates to the current year.
But
So
the effect is felt this year. So
the company, if people are owing you last year and they haven't paid, would the amount be in the last year?
okay, 2021. Okay. We are reporting for 2022. So it's okay.
Right.
Sure. 3,000 then.
Okay. But this particular 3,000, we can write it as bad debt because we are not going to be taking the money again. So the appropriate word should be bad debt so that you get a treatment. Okay. The appropriate word should be a bad debt. Okay. Yeah. So we are taking the 3,000, which is included in the amount over here. But the bad debt, which is as a result of the fraud, let's name it bad debt so that we can get the money. 2,000 is relating to this year, isn't it?
yeah.
And 1,000 relate to what?
Previous year.
Okay.
The year before.
Okay. Fraud is what?
So revenue will be affected.
Okay. So we come here and say proud year adjustments. So in the statement of changes in equity, we are going to be adjusting our retained earnings over here. So we have the proud year adjustments. So that will be proud year adjustments. That will be the fraud. We come here and reduce our this figure by 1,000. That is
Retained earnings.
That is relating to the last year. And the profit for the last year is included in the opening balance of the retained earnings for this year. Okay. But the 2,000, which is for this year, will now be charged against administrative expenses. So let me go here and have.
Go against administration.
Yes, we charge it against administrative.
What bad debts?
Okay. Or if you like, you add it to distribution, there's no problem. But it should always be added to the administrative expenses. Okay. So we add the fraud, or maybe you can name it. If you are naming it bad debt, it will actually be selling and distribution, but just add the 2,000 here. All right. There is no cause for alarm. Okay. So let's take the last one, then we put our figures and move on.
Almighty taxation.
Taxation.
Yeah.
The directors have estimated a provision for income tax for the year ended 31st December 2022 at 11.3 million Ghana cedis.
All right, stop there. What are you going to do with this balance? Straightforward. Where are you sending it?
That's your current.
Current tax. Current liability.
Current tax.
Current.
Okay. So that will be your current asset. What is the current tax? 1,300. That is the amount that you are saying that you are owing now. So you have to bring that one as a liability. The current tax is the tax that you are saying that you are going to be paying for the current year. So that will be a liability for you. Let's come to the tax schedule now. Okay. We have to do our tax schedule. Okay. So we bring our current tax now, which is the tax for this year. Then we now adjust some items against it.
Under provision.
Okay. So what are they saying again concerning that? Yeah.
The balance on the current tax account in the trial balance represents an overall relating to the year. The carrying amount of the net assets were 24 million Ghana cedis in excess of their tax base.
Is it my network or?
I think it says.
Network.
Okay. So the applicable tax rate is 25%, but let's take it from this one. The balance on the current tax account in the trial balance represents an over or under provision relating to the year 2021. Let's go and check where the balance is.
It's at the debit side, under provision.
So debit side means what?
Under provision.
Provision. So that should be added to the current year. So it means that we have undercharged. So the tax has to be increasing. So we have under provision here. Okay. Under provision of 100. Okay. Then we have to calculate deferred tax. We are giving temporary difference over there. Okay. What is the temporary difference over there?
24 million.
Okay.
24.
Which is a taxable temporary difference because our carrying value is higher than the
It's above.
Okay.
Yeah.
So let's calculate the deferred tax. That will be deferred tax provision for this year will be 0.25 multiplied by 24,000. That will be the total deferred tax. What are we going to be having?
6,000.
6,000. Okay. So our total provision now is 6,000. What we have to do is that go and ask yourself, what is the existing provision?
Factor 800.
What is the existing provision?
Yeah, factor 800.
For deferred tax.
Yeah.
Five
Deferred tax
800.
provision.
I think it's 5,800. 200 movement under.
So there has been an increase of what?
200.
So the movement will come here as an addition. So movement in deferred tax. Please, this is just treated like a normal provision. It's just like maybe provision for doubtful debt. Increase should be charged to profit or loss, and decrease should also be charged, but that will be a reduction. But let's come to our statement of financial position. Our deferred tax for this year was
6,000.
6,000. So that it has increased to 6,000. Let's come to our tax now. So what will be the total tax expense?
7,600.
Okay. 11,600. So we go to the tax expense. So maybe you can stand, you have your 11,600. Okay. So let's put administrative expenses together. Administrative together.
Sorry.
Yeah.
Yeah, it's about the tax. The applicable tax rate is 25%. I think they use 20%.
Is it 20? But the 25 is the 6,000.
Yes, sir.
Okay. So
Okay.
don't worry about the rate. Right. So let's total our
6,000.
administrative expenses. I'm having 3,100. Administrative is 3,100.
It's 11,600, right?
Yeah, 3,100.
Okay. So administrative, let's say that is working 6. So other income will be 600. Administrative will be 3,100. Okay. So my finance cost is now 27. 81.4. 81.4. Okay. Distribution. Distribution, there's nothing to the distribution, so we can bring it there. Our distribution cost is what? So, please, yeah.
11,000.
We haven't done some things. Interest on bank overdrafts, interest on loan notes, equity dividend paid. Okay. We also haven't touched the 8% preference shares. Sorry. Okay. So the interest on loan notes, interest on the loan notes is how much?
100.
It's supposed to be 1,000. All right. That is the amount paid on the loan note. But interest on bank overdrafts. Okay, we have to capture that one also as part of the interest finance cost. So interest on bank overdrafts has to be captured. Then we have the interest on bank overdraft must also be captured. So let me just go and do the total finance cost now. Okay, so let's do the finance cost very well. Okay, so we have the finance cost on the lease. That was 1,653.4. Then we come to the convertible instruments. That will give us 1,128. The interest on bank overdrafts. Bank overdrafts. Bank overdraft is how much?
200.
Okay. Okay, that will be 200. And let's have a 200. Then let's come to our preference shares. Okay. We haven't touched the redeemable preference shares. Okay. So 8% redeemable preference shares. How would the preference shares be treated?
It's a debt.
Okay, so that will be treated as a financial liability. So let's come to the redeemable preference shares. Okay, so the redeemable preference shares, what will happen is that we are going to be having the balance at the start. Balance at start. How much is the balance in the trial balance?
It's not 20,000.
Okay, that is 20,000. So that 20,000 will be here. Then their dividend will be treated as a finance cost. So finance cost will be 0.08. Since they haven't said anything about effective interest, the nominal rate is the same as the effective interest rate multiplied by 20,000. What are we getting?
1,600.
Okay.
1,600.
Okay. And this, the same time we are going to be paying, they will receive a coupon of 1,600. So this will still be the 20,000. Okay. But if we come to finance costs, we are going to be having preference shares over here in addition to the finance cost. That will be 1,600. What will be our total finance cost?
Four five eight 1.4.
1,8 in addition to
Okay. 4, 5,
8 1.4.
okay, that's 1.4.
458 to 1.4.
Okay, so we have 4581.4. Okay, let's go to our statement of the preference share will still be 20,000 there. Okay, so we have treated the bank overdraft interest also already. Interest in bank overdraft, interest on loan notes. That is the interest on loan note is a convertible one, which will be a 1,000. Investment in equity shares. What is the distribution cost? Distribution cost is what?
11,000.
Yes, sir.
Okay. So distribution cost is 11,000. So let's go and bring that there. 11,000. Distribution cost will be 11,000. Okay. So can we calculate our profit before taxation?
We get 538,884.6.
Okay. So let me bring this one and bring it here. 84,946.6. So 548.
538.
Okay.
884.6.
538. 88.
884.6.
884.6. Okay.
Somebody can confirm it.
Eight four 946.6 plus 600 minus 30, 100 minus 11,000 minus 4,581.4. I'm getting
I'm getting a different figure.
39,865.2.
Yeah, you are right.
Okay. 39,865.2. So our tax is 11,600. 11,600. So I'm getting 2,665.2. Okay, that will be the profit. Then if we add these figures to it, you get your total comprehensive income for the year. So we have 1,500 and 400. So plus 1,900. I'm getting 30,165.2.
Please, can you go back? Let me see your gross profit figure. Okay, thank you.
Okay, so this. Okay, so let's count to profit for the year. This will be dash, this will be dash, and this will be dash. This will be dash. So we have 1,900 here minus 1,000. Okay, so let's go and have profit for the year. profits for the year, profits for the year, or profits after tax. The profit after tax will be the profit that we have calculated, 28265.2. That will come under retained earnings. So 28265.2. Okay, so this will be dash, this will also be dash, then the total will come here as 28265.2. Let's come to equity dividend paid. What is the dividend paid for equity? So in the question, what do we have for equity dividends?
$6,000.
Okay, so equity dividends will be 6,000. That will be taken away from this. Okay. So let's just find our stated capital will still be 50,000. So you go to your stated capital, you bring your 50,000 here. Okay. So you come to your retained earnings. What will be the figure for retained earnings? So let's bring the retained earnings there. That will be 19,600. 19,600 minus 1,000. 19,600 minus 1,000. Plus 28,265.2 minus 6,000. I'm getting 40,865.2. So that will be our retained earnings, 40,865.2. Then you count your capital surplus. The capital surplus will be 11,900. So 11,900. You can just total that one to get your total. So 11,900. Your deferred tax, your lease liability, your preference shares, and let's come to our trade payables. We need not to have cash and bank here. Cash and bank are supposed not to be here because they are having bank overdrafts. So we have bank overdrafts of how much? What is the overdraft balance? Overdraft is how much? Okay. So overdrafts is 1,300. Okay. Payables is how much?
Okay. 23,800.
23,800. Okay. So we are left with one receivables. What is our receivables figure?
What is 100?
43. No, we have done working for the receivables.
Okay.
34,100.
Okay. I'm getting 34,700.
No. Yeah, 300.
Okay. 34,700. Okay. So you cannot put your figure together. What is it? You have spent more than 2 hours today. Hey. Okay. That is well.
Yeah, Levis, I think this question is coming from you direct.
It's coming from.
You personally, because the footnote alone.
Oh no, it was this thing. It was an assignment that one of my guy at UG, he sent it to me that I mean the examiners are the lecturers. So
Okay.
he sent it to me that I should do it for him. So after doing it, I also have another one with a plenty footnotes. But just that no, it's too plenty. Okay. But if the IC, they're even going to they are going to load. Sometimes they don't audit the questions before bringing it out, because you look at it, you see that no, this particular question, that the footnote is too much. But that is why they make it 50 marks for you to pass. So there's no big deal. All right.
Because yesterday console is full of standard.
Yeah. That's what they have been doing for some time. But now they are trying to go back. Let's see whether we can do the final account question too. And that is the reverse one. Sometimes they will prepare the statement and give it to you. They will prepare the statement without taking into consideration certain items. Then they will now be expecting you to come and take the additional footnotes and come and adjust your statement. That is the question number 2. Let's see whether within 30 or 40 minutes we can finish that and do some standards before 4 p.m. All right. So let's see. Question number 2. Do I have the space? Okay, let me see if I can have.
Hello, sir.
Yes, please.
Just get to the current asset for me. Let me look at the current asset. Okay.
All right.
Thank you.
Auntie Patrick, don't be discouraged. Oh.
Please, I'm here.
Okay. Okay. We are going to be preparing this, so please just let's still put our items there. And
Hello, sir.
yes, please, yeah.
Sir, the dividend paid, is it
Yeah.
600 or 6,000?
Dividend is 6,000 for the equity shareholders. Or I wrote 600.
No, you wrote 6,000.
Equity dividend paid. Can you see the equity dividend, please? 6,000. The dividend that will go to the statement of changes in equity is equity dividend, unless the preference shares are irredeemable preference shares. Okay. Preference dividend is treated as a finance cost, so that's why we added it to the finance cost, because it's redeemable preference shares. Okay. So I hope you are okay now.
Yeah.
Okay. Auntie Patricia, you are going to be taking the second one for us. But what will happen is that let's put the structure there. We are going to be having revenue, cost of sales, gross profit, administrative expenses, distribution cost, profit before tax, tax expense, profit for the year, and we'll see what we can do about this one. Okay. So let's look at TAFO. Okay. So let me just put the question number 2 here. So we have the TAFO Limited statements of, that is revised. Okay. Revised statement of profit or loss and other comprehensive income. If you have time, you can add other comprehensive income. Okay, so we have the revenue. Okay, we have our cost of sales. We have our gross profits. We have our admin expenses. We have our distribution expenses. Then we are going to be having our, let's see, finance costs, if any. Then we have profit before, so profit before tax. Then we have our tax expense. Then we have profit after tax. Profit after tax. Okay. So what I'll do is that let me do my revised statement of financial position. Financial position as at the, then we have our currencies sign here. I'll have my assets. I have my non-current assets. Non-current assets. Then I have PP there. Okay. What are the non-current assets reported in their statements? It's only PP. So let's leave like 2 space there and come to current assets. Okay. What are their current assets reported? We have inventory. Okay.
Trade receivables.
So we have the trade receivables. You have cash and bank?
Yes, there's bank.
Okay. Cash and bank. And we have total equity. Okay, let's have equity and liabilities. Equity and liabilities. Okay. And this one we have the stated capital. We have the retained earnings. Okay, do they have any item on under the stated capital again? Okay.
11% preference shares.
Okay, the preference shares, we go and look for it and see if it is redeemable. If it is redeemable, it will be treated as non-current liability. But if it is irredeemable, then it will be under the equity component there. So we look at what the preference shares will be there. So we can count the non-current liability, which we don't have any. But if there's any, how do we go about it? So non-current liabilities. Okay, so we count to current liabilities. Current liabilities. And what are the items under the current liabilities there? We have
Trade and other payables.
Trade and other payables. Okay. The next, another one is what?
Current tax.
Okay. So we have the current tax. Okay. So we have the current tax. So with this, we can now start taking our footnotes one by one and see what and what we have to do and what and what we don't have to do. Yeah, Auntie Patrick.
So I should start from the company, however.
Yeah.
The company, however, has not incorporated all relevant financial information pertaining to the year ended 30th September 2008 in the draft financial statement. The following may be relevant. A. Included in property, plant and equipment is a production machinery acquired in October 2005 at the cost of 3.25 million Ghana cedis. The estimated useful life of this machine is 10 years. In 2006, environmental protection laws in the locality that Tafo Limited operates tightened, limiting the amount of production companies could do, especially at certain times in a day. Accordingly, An impairment review was carried out on 30th September 2006. The fair value less cost to sell and the value in use were estimated at 2.34 million and 2.47 million Ghana cedis respectively. The outcome of the impairment review was accounted for correctly in the financial statements for the year ended 30th September 2006 in accordance with IAS 36, impairments of assets. Subsequent to the impairment review, the industry of Tafel Limited has in recent times experienced a relaxation in the tight environmental laws imposed in 2006. Amount of production from production machine has increased. Consequently, an impairment review has been carried out by management of Tafel Limited on 30th September 2008 on the production machinery again. The fair value less cost to sell and the value in use estimated at this date are 1.82 million and 2.08 million Ghana cedis respectively. Property, plant, and equipment are recorded at their carrying amounts at 30th September 2008. That is after depreciation of the year, but before the effect of impairment review undertaken on 30th September 2008.
Don't worry. Myself, I'm tired looking at the footnote alone. So you reading, you have to be tired. All right. What are they trying to say over here? They are talking about an impairment was conducted on a property, plant, and equipment because of a government legislation that is what limiting the production of a particular machine. What it means is that whenever you are going to be purchasing an item, okay, when you purchase plants, you have a target, or the plant has a maximum capacity to produce. So let's say you have a plant that is going to be producing, you purchase a plant at 45,000, which is going to be producing 50,000 units every year. Okay, maybe for 5 years. So now it means that the 45,000 is relating to what? Production level of 50,000 for 5 years. Okay. Now, this will be 250,000 for the 5 years. Now, government has passed a legislation that is restricting the production now to what? To 40,000. Okay. It means that you'll now be getting what? 160,000 for, that will be 200,000 rather. Okay. That will be 200,000 for the 5 years. Okay. 200,000 units. But the 45,000 is 250,000. Okay. So how much will give us what value of the machine? If 45,000 is giving us 250,000 for 5 years, how much will be giving us this one? It means that the value of the asset, the benefit of the asset will no longer be what? 45,000, because the 45,000 is giving us 250,000. But now the production has reduced to 40. We are only going to be getting the 200,000 units. So it means that if we are carrying the asset at 45,000, we are carrying the asset at a value more than the benefit that we are going to be getting from it. So the value of the asset has reduced technically as a result of the government legislation. And the reduction in that particular value is what we are calling the impairment. It's not the value
Capacity impairment
associated with the asset is what we call the impairment. So that is the idea about the impairment. The time that we purchase the asset, what is the cost? What is the associated benefit? And what is the benefit now? Is the benefit reducing? It means that if the benefit is reducing, what is the equivalent value of the asset that can give us this benefit? That should just be the recoverable amount of the asset. So that is just the idea about the impairment. But let's come to this particular question. Okay, there was an indicator of impairment because environmental laws has been issued or has been passed. It's now going to be having issues with that. So the limitation, we cannot produce up to the quantity that we have to produce. And as a result of that, impairment was conducted. The first impairment was conducted on what? The first impairment was conducted
30th September.
30th September.
So let's come to workings here. Okay, so let's come to two of impairment. So the first one will be on impairment, the workings one. Okay, the workings one will be on the impairment. So what we are going to be doing is that we are just looking for, you can see that the issue over here is a reversal of impairment. But the question is, what portion are we going to be reversing? That is what we are coming to look at now. Okay, when was the asset purchased?
Two 2005.
Okay, October.
October
Okay.
2005.
So from October to September 2006, that is 1 year, isn't it?
1 year. Yeah.
So at 30th September 2006, we need to know the carrying value of the assets compared with the recoverable amounts. So the carrying value will be 3250. We are keeping 3 zeros at the top, minus 3250 divided by 10. Is that correct? The useful life of the asset is 10 years. So
Yes.
be the cost minus the depreciation for the first year. What are we having as the carrying value?
$2,925.
29.
2,925.
Okay. 2925. So that is the carrying value at that date. But what was the recoverable amount? What was the recoverable amount? What was the recoverable amount at that date? Let's go and check. Okay, the fair value less cost to sell is 2.34 and the value in use is 2.47. Which of them are we taking?
Higher.
Okay, so that will be 2470. So what will be the impairment loss? That will be
455.
Okay. Okay, that will be 455. This has been accounted for correctly. Okay, going forward, from 1st October 2006, the value of the asset will now be, the recoverable amount will now be the value of the asset. Do you agree?
Yeah.
Okay, the recoverable amount will now be the value of the asset. So let's now go and ask yourself, when was this done? There has been an impairment, subsequent impairment review again, which is done on what date?
2006 September.
No, that is the first one. We have accounted for the first impairment, which is 26 September. That is the first one.
Okay.
But after that, there was an impairment review again.
That'll be
Subsequent one was done.
2008.
Okay, so that will be 30th September. So we come to the subsequent impairment review. Okay, so the subsequent impairment review. What will happen is, so what will be the carrying value of the asset at this date? The carrying value of the asset will be
recoverable amount minus accumulated depreciation.
Okay, so we have 2470 minus what? 2470 divided by how many years?
We've done one already, so it will be
9 years, right?
9.
Okay, multiply by
9.
multiply by 2, isn't it? Okay.
Yes.
From October 2006 to 30th September 2008, that is 2 years. So what will be our carrying value?
549.
Okay.
Planning figure.
So
Okay, sorry.
2470 divided by 9 multiplied by 2. 549. Okay.
Yeah,
This is
planning
549, isn't it?
Yes, sir.
All right. So we have our carrying value.
1921. 21.
21.
Okay. So let's come here. What is the recoverable amount here? What is the recoverable amount at this date now? What is our recoverable amount at this date?
2.08
We are
million.
picking the highest one, isn't one? So
Yes,
that will give us 2080.
0.08.
Okay. So there will be an increase, isn't it?
Yeah,
There will be a gain of 2080. How much is the gain?
$159.
159, yeah.
This 159. What was the impairment recognized first?
455.
Okay, so 455 you have done only in 2 years, even if you reverse this particular one. So there was impairment of 455. Now there's a gain of 159. It is below the 455, so you can reverse all the full amount, but I will show you how you can reverse it. Okay, if we reverse it, you will still get the same value. The reversal is done as, okay, you ask yourself, what if the impairment has not been done? What if the impairment has not been done at all? And the day that we are doing the reversal, that is where the impairment is done. That is the first time that we are carrying out impairment tests on the assets. Okay, but what I want to tell you is that whenever the gain is below the actual impairment loss recognized, you can recognize all the full reversal. Okay, but this is how it is being done. If you want to reverse the impairment, you ask yourself, what if the impairment has not been carried out on the asset at all? What would have been the carrying value of the asset at today? Compare with the recoverable amount at today. So what should have been the actual impairment, or what should have been the actual carrying value? Then we just increase the value by that. So I will show this one. I will show this one now, that we are doing the impairment test now on 30th September 2008, isn't it?
Yeah.
Okay. Okay, let's assume that the impairment was not carried out in 2006. What would be the carrying value of the asset at this date?
3250.
Okay, it will be 3250 minus 3 years depreciation, isn't it?
Yes.
Yes.
So the carrying value will be 3250 minus into bracket 3250 divided by
Over 10 times 3.
minus 3. What would have been the carrying value?
$2275.
Okay, so this will be 3250 minus 975. Is that correct?
Yeah, 975.
Okay. So the carrying value will now be 2275.
2275.
Okay. So let's assume that this is this particular day that we are doing the impairment. Okay. So if this is the day that we are doing impairment, our recoverable amount will be 2080. Do we agree?
Yeah.
Yes.
Okay. So it means that the actual impairment that should be recognized on this asset should be the impairment loss.
195.
Okay. The impairment loss should be 2275 minus 2080. Is that correct?
Yeah.
Okay.
195.
The impairment will be 195. Okay. And the carrying amount should be what? The carrying amount has
200.
200. Okay. Okay. All right. So the carrying amount should be 200. That should be the carrying value over here. 200. Okay. But what is the carrying value in the books of the entity?
3250.
No, the one that we have, they have done the impairment, so this is the carrying value they have at this date.
Okay.
Okay, but the carrying value should be 2880. Okay, what is the difference?
159.
Okay, so you just add the 1592 to your value over here to reflect the actual carrying value that should be on this date. So if the impairment has not been done at all, this is supposed to be the carrying value, but the entity has impaired the assets, so they have 1921, but the actual carrying value should be 2080. Okay, if the impairment has not been done at all. So how much do I need to add to the carrying value in the books of the entity to have my what? To have my the 2080. That is the amount that you are going to be reversing. Okay. The question is, someone might be asking, okay, why the total impairment was 455, but the actual impairment that should have been recognized is 195. Okay. So what will be the impairment that is not, what will be the impairment? What will be the,
260.
okay. The actual amount that we're supposed to reverse is 260, but why are we reversing 159? Come here. If the impairment was not done, what should have been the depreciation every year? It should have been 325, isn't it?
Yeah.
Okay.
325.
Okay. But after the impairment has been done, what was the depreciation charge to the statement of financial position? That will be 1549 divided by 2. Is that correct?
Yes. Yeah.
So we have charged 274.5 today. So what is the amount that we undercharge?
50.5.
Okay, we charge this one for 2 years, so that will be 101. So it means that the impairment has reduced our depreciation by this. So if you want to reverse all these amounts, you have to make sure that you have taken the impairment that has been undercharged, the depreciation that has been undercharged as a result of what the impairment. So subtract 260, subtract 101 from 260 and see, you'll be getting
159.
Okay. So the reason why we are not reversing all the 260 means that the impairment is bringing in a lesser depreciation. So since the impairment is supposed not to be done, it means that the depreciation relating to that particular portion was taken to profit or loss. So that is why we only look for the increase in the carrying value and add. Okay. So this is how you also go about it. You ask yourself, if the impairment has not been done, what should have been the actual carrying value? You haven't done any impairment before the recent impairment. What should have been the actual carrying value? And what is the carrying value that we have as a result of the impairment? The carrying value was 9,21921. But if the impairment has not been done at all, it should have been 2080. So we have to come and increase that figure by 159. So the entry for this will be debit your assets. Debit your asset with 159. What would the credit be going? We are reversing impairments. So what would the credit be going?
Profit.
Okay. So we credit our profit or loss, or you credit your administrative expenses. This was charged as expense. So you reversing it now means that it will be treated as income. So let's go to our statement of financial position. We have the PPE. What is the value of the PPE for them?
Um, 60,424.
Okay, 60,424.
424.
Then we add 159. Please, everything about the asset has been done. The question has said that you have been informed that everything about the asset has been done. Okay, the property, plant, and equipment. Property, plant, and equipment are being what? Are recorded at their carrying amount at 30th to 8. That is after depreciation for the year. The only thing that has not been taken into consideration is the impairment. So that is why we are coming to do the entry for only impairment by adding the 159 and reversing this one. So the next working that we have to do is we have so let's have the working 2. Then we now have administrative expenses. So we write the amount against administrative expenses.
So the 159 was added to the asset, right?
Yes, we are adding to the assets. So as per statements, please, they can lift the footnote and give it to you as a standard. Okay, I've seen that before. Okay, what is our administrative expense in the statement given to us?
That's 73549.
73549. So we are reversing the impairment. So reversal of impairment loss. Reversal of impairment. So the impairment was charged to administrative expenses.
73.
Okay. The reversal, addition or subtraction?
Subtraction.
Okay. This is an income, so we will subtract from this. All right. please, they can lift this particular footnote and give it to you as a standard. You need to explain before you go with the workings. I have seen that before. So this is
You need to explain before you start the working.
Yeah, you need to write this should be accounted for this and this before you can start the workings. So sometimes write the English. Okay, this particular transaction should be accounted for in a line with IAS 36, impairment of assets. The standard says that whenever there is an impairment review and there is a gain, the gain should be recognized in respect of the asset being assumed that there was no impairment charge on the asset. So write the English before you start. They will give you like 2 marks for it. Yes, sometimes you identify the standard and write.
If there's a gain, the gain should be recognized as.
The range should be recognized to the extent. Of any increase in the carrying value, provided the impairment has not been done.
Okay.
Okay. All right. So yeah, if you always have to write, because I have a marking scheme. I have the master marking scheme for corporate reporting, and the question on standards, although the question will be demanding for calculation, but you still have to you can write something small. There's a mark for maybe at least 1 mark for maybe what the standards, but you should not write plenty. If they say calculate. Okay. If they say recommend, you still calculate and tell them how the figures will be treated. If they say advise, if there's figures over there, you will still use the figures to explain which figure should go to profit or loss, but there should be English at least. You can use English to go with it. B. Yeah.
On 1st September 2008, Tafo Limited purchased materials used for production of its products at $0.78 million under a 90-day credit term. The exchange rate of $1 in cedis is of $1 in cedi at the purchase date was 6 cedis. At 30th September 2008, the exchange rate of $1 in cedis is estimated at 6.15 Ghana cedis. The purchase is included in cost of sales and trade payables at their transaction values in cedi terms at 1st September 2008.
Effect of exchange transactions.
So this is what?
Exchange transaction.
IAS what?
IAS 21.
Okay.
21. Effect of foreign decrease in
Senior, anyway, if you're able to identify it without giving the exact standard, that'll be you get
No,
marks for that.
nobody will give you. This is footnotes. So you are coming to work with a footnote.
No, I'm saying, so for instance, just as you said, like the initial one where they can put the standard in the footnotes and they will ask you to write some English.
This one, this question, giving this question as a standard on its own is too easy. Okay. So
They don't want us to pass.
Yeah, the footnotes for what normally happens is that if you come to the standards, the footnote for the standards, you can adjust everything. But if you pick a standard question, it will worry you. Okay, because the footnote is always maybe some surface of the issue. So that is why that one is always like that. But okay. So that is not an issue there. Let's see what we can do. And okay. So let's see what we can do. Okay. So this is what the transaction was recorded at what? So this was on 1st September 28. Tafo Limited purchased material used for production of each product at 0.8 million under a 90-day credit terms. The exchange rate of this in cedis at the purchase date was what? 6 cedis. Okay. At 30th September 2008, the exchange rate of in cedis is estimated at 6.15. You can see that our exchange rate is now increasing, isn't it?
Yes.
Okay,
Yeah.
increasing by 0.15, 15 pesos. Okay, so
Mm.
if we want to pay these people on the reporting day, we are going to be losing. That's what you just have to look at. That there will be a loss there on what? There will be exchange rate loss. So that's what they're asking you to do. Okay, let's come to the transaction date. This is what we do. Okay, the exchange rate loss. Okay, 1st September, what will be the entry that will be passed relating to this transaction? 1st September, what will be the entry to be passed on this transaction?
You
We are
debit your assets.
okay.
Debit your inventory, credit
Oh,
income.
okay. Also, we debit purchases. Are we reporting in USD?
No.
No,
City.
No.
GHC.
So we
It's
change the USD to what?
Ghana
city.
cedi.
City.
So that will be 0.78 multiplied by 6. Is that correct?
Yes, sir.
Yes.
Okay. How much are we having?
Yes.
4.68.
Okay. So we are having 0.78 multiplied by 6. So we are having 4.68. Okay. So the payables will also be 4.68. Okay. Did we pay on that day?
No.
No.
Okay. At the reporting date, we are still owing the people what? 0.78, isn't it? Okay.
Yes, sir.
Yes.
But if we want to pay them in cedis, how much are we going to be paying them?
6.5.
Okay. So we have 30th September. So if you want to pay the person now, how much are you going to be paying the person now? That will be the payables at the reporting date will be 6.15 multiplied by 0.78. What are we having?
4.79.
4.79.
So
4.
4.8.
So 4.8.
4.8.
Okay. Please, you have to know that you are keeping 3 zeros at the top. So if you multiply by 1,000, what are you having?
Oh, okay.
4680 and 497.
Okay, we are keeping 3 zeros at the top. I hope.
4797.
Okay.
4797, yeah.
Okay, that will be 4797. So just bring up 4.797, isn't it?
Yes, sir.
Yeah.
Yeah.
Okay. But what was the amount we have in our books relating to those people?
4680.
So what is happening now? It means that we are paying them additional amount. Okay. So that will be the loss. So let's find the loss now. Okay. The loss will be 4.797 minus the amount that we are owing them. Give us how much?
0.11.
So that will give us
0.11.
0.
117.
11.
Okay. But this one we are keeping 3 zeros, so multiply by 1,000. What are we having?
It's 7 instead of 6.
It's 7. So
Okay.
it should be 117.
Okay.
1170.
That will be 117 Ghana cedi. So
Yes.
this loss, go and add it to your administrative expenses. Okay. So let's come to exchange loss. Okay. If you show it as an item, to no problem. So that will be 117. What will happen to our payables?
Increase.
Okay. So let's bring the payables figure here and then increase it. What is the payables figure they have?
That is 7862.
7862. So we add a 117 to it, isn't it?
7860.
Okay. So we add a 117 to it. All right. So
Yes.
that is for that one. This is just the exchange rate. At the end of the year, you are not paying the person. Like if you are paying this by cash, you credit your cash, and that is the end. Okay. At the time that you purchased it, you are owing the person 4.68 million. At the end of the year, if the exchange rate is still 6 cedis, it means that you are still owing the person in the cedi equivalent of 4.68 million. Okay. But now the exchange rate is 6.15. If you want to pay the person now, how much are you going to be paying the person in cedis? So you find that particular amount and you compare with that. Someone can also find this particular 4.7 like this. The loss the person can just look for 6.15 minus 6 multiplied by 0.78 or 780. I hope we also agree with that.
You get the same thing, yeah.
Okay.
Get the same, yeah.
So the person can calculate just the increase in the exchange rate. So we are paying 0.15 or 15 pesos in excess. So what would be the what? The okay, I'm sure this will be 7,800. Okay. Or is 780. 0.78 multiplied by 1,000. Okay.
Will be 780.
Okay. So you can also get the same.
So, but why don't you always teach us the shortcuts?
Can you be a shortcut? They will block up. It's not everywhere shortcuts will take you.
We need
No.
to pack. We need to pack before learning the rating.
We have 36 minutes, so we need shortcuts.
That's why I'm giving you the alternative. Okay. Some people
It's rather confusing us.
Okay. You see, I believe in understanding. Okay. If you understand a thing, maybe you can find your alternative way to go about it. Are you okay? So that is it. Okay.
So, Sinelon, in this
Yeah.
case, assuming that at the reporting date, you are paying the people, you credit your cash, right?
Yeah, if you have
Then
actually
pay
paid
them.
them on that particular date. Okay. So if you pay them on that particular day, the entries will now be debit your payables. Okay.
Payables.
The payables that you'll be debiting is supposed to be 4.68. I will explain. Okay. Or you debit payables of
With the
4.6.
difference, or
Yeah. The payables, the current amount that you are having now is 4.680. You haven't incorporated the exchange rate loss yet. Okay. So the difference of this will go to profit and loss, which will be 117. Then you now
okay,
have credit your cash or bank to be
with
the
the 4797.
4797. Okay. The payables is still at the 4680. So if you have actually paid them, this out we are going to be doing. Okay. But we are using 90 days, so still we are owing them. Okay. So
Okay.
that is to be the issue there. Let's take the first one is the
Yeah.
only. Yeah, Sina.
So the exchange rate loss relates to material that we use to production. Since won't just go to the cost of sales. More than increase your cost of sales, the item to the
The item we are purchased at the inventory will be at cost. Okay. But what is happening is that the amount that you are bringing in, is because you are paying on credit. Exchange rate losses on item that you are purchasing should not be capitalized as part of the cost of the inventory. The inventory is what is the today's amount? Is because you are not paying. That is why the exchange rate loss is coming. So this is not a cost to make the inventory available for sale. The inventory is already available for sale. So the exchange rate loss is not added to the inventory. Okay, it cannot be part of the cost of sales. It shouldn't be part of the cost of the inventory. All right.
Oh, okay, so if it shouldn't be part of the cost of the inventory, which is in the cost of sales, I mean we are going to deduct it from the cost of sales.
They haven't included that. They only included the amount that you purchased, which was a 4.68.
Please get to the worksheet for me.
Okay. They have done only the 4.68. Let's take this one first. They say this purchase is included in cost of sales and trade payables at their transaction values in CDs at 1st September 2008. So the value of the item that you purchased at this date was 4.68. That is what they have included in cost of sales. That is right. Okay. If you purchase the item by paying cash, it will still be the 4.68. That is the price of the inventory. That is fine. But you are not able to pay, and there was losses. These losses should be shown as a separate item. Okay, so the exchange loss is supposed to be shown as a separate item, but we don't want to do that. So let's just charge it to administrative expenses, part of the administration of. We are going to be administering our trade payables. So it's part of the issues relating to administrative expenses. Exchange loss should not be added to the cost of the inventory. The only cost that should be added to inventory is the cost of bringing the inventory to the state that it can be available for what? For sale. And exchange rate loss is not part of those what? Those costs. Okay.
Okay.
Yasinia, which part do you want? The relationship?
Okay, yeah.
Okay.
The
second
last one.
Okay.
The last one.
All right. Yeah. Someone say he wants shortcuts, but you are getting ticks. This shortcut will give you only two ticks. Okay. It's not anything. You see, for me, passing the exam is not anything. You are the people that are saying it to be something, and that is why it is worrying people. Okay. It's just like a normal exam. What exam you haven't written before? You have written BC, WASI, diploma exam, degree exam, and what? Yes. Let's do away with the fear,
Okay.
unless you are not prepared. Okay. Let's come to C.
C. The 5 years 11% preference shares presented on the statements of financial position was issued at the beginning of the current year and are recognized at par value of 13 million Ghana cedis. The company incurred issue cost of 0.8% of the par value, and the preference share is redeemable at a premium of 5% over the par value. The effective interest rate of the preference shares is 12%. Issue costs paid is included in administrative expenses.
So this is about financial instrument, isn't it?
Yeah.
Okay. The redeemable preference shares will be classified as what? Non-current liability, isn't it? Because of
Yeah.
the years, it's 5 years. So that will be not true profit or loss. So this will be treated as a non-current liability or financial instrument classified or financial liability not classified through profit or loss. Okay. And that should be accounted for using amortized what? Cost. Okay. So we need to account for this one using amortized cost. So let's count to the working three. That will be redeemable preference shares.
So I think it should be 4. Exchange rate was 3.
Which one?
The exchange rate.
This one should be 4. Exchange rate was 3. So this should be 4.
Okay. So this will be 4. Okay, I've forgotten the administrative expenses there. Okay. Please, how do we account for this? Someone's hand is up. Also, on that.
Sir, please, good afternoon.
Yes, please.
Please, I just joined in. I don't know if I've missed a lot or I should wait for the recorded video to follow the class like that. Because when I saw that it's information, I knew that it was very bulky. I am confused if I should wait or I should follow the class.
You have already advised yourself.
We are waiting for the elders to comment. So elders, what do you suggest?
She should listen to the video.
And then the recording will help.
But she can follow. It doesn't mean she has to leave. She can follow the one you are doing so that she
This is a question, so she can follow.
But so you can pick it from the foreign exchange so that she'll follow. The others is not anything she can.
Okay. But she will still watch the video. So it's better she use this time to do other things. Okay. If you want to sleep, maybe you can sleep. If you want to go and eat, maybe you can go and eat so that you come and watch the thing from the beginning to the end. Because even if you are going to be watching, you will still watch from the beginning to the end. So it's double work that you are doing. Time is money. All right. But if you still want to be with us, there's no problem. We don't have any problem with that. Okay.
But taking too many subjects, yeah.
Okay. So how do we treat? How should this be treated? How should the issuing cost be treated if we are carrying this as financial liability through amortized cost. The issue cost should be what?
So it will be subtracted from the initial cost.
So it should be capitalized, isn't it?
Yes.
But what are they doing? The issue cost has been what?
As in expense.
Okay, so we go and remove that one. We go and reverse that one. So let's find the issue cost first and reverse it from our administrative expenses. So it means I need to bring this one down small. So let's have the issue cost here. So what will be the issue cost? 0.008 multiplied by 0.8%. So if you are changing that to 100, what are we having? So 0.008 multiplied by
104. 104.
Okay, multiplied by the amount is what?
30 million.
Was it the 30 million?
Yes, please.
Yeah.
That is the 13 million. So we are having 104, isn't it?
Yeah.
Okay. This included in administrative, was it added first or it was subtracted?
Added.
Added.
It was added.
So we have to come and reduce by subtracting. Okay. So let's now go to how to account for this. So we have the purchase price over here. Okay, and the purchase price will be 13,000. Then we now have the issue cost. Okay, the issue cost will be 0.008 multiplied by 13,000. So that will be subtracted. We have 140. Okay, so what will be the fair value now?
It's 104.
It's 104, yeah, 104.
104.
Yeah.
Yeah.
Not 140.
No, 104.
104.
Okay. Sorry. Okay, that will be, so this will be 104. So we have 104 here. 104 here. Then we have 104 here. Okay. 104. Okay, so the fair value will be what?
12,896.
Okay, 12.
12,899.
Okay.
12,899.
So what do we do? This is where we charge the finance cost over here. Okay, the finance cost will be charged using the effective what? Interest rate because of the issuing cost and also the premium. Please forget about the premium. The premium that you are paying has been taken into consideration when estimating the effective interest rate. So the premium that will be paid at the end of the year will be reflected in the effective interest rate. And the effective interest rate for this one is what?
12%.
So we multiply this by 12%. So 0.12 multiplied by 12, 896. How much are we getting?
1547.
Okay.
154. Approximately.
That will be approximate. So 1548.
47.5.
Okay, let's make it 1548. Okay.
Yeah.
What will come? The dividend that we are going to be paying to them will be treated as coupon. Okay. So what will be the dividend that we are paying?
That will be 1430.
So that will be 11% multiplied by 13,000. It will always be paid on the nominal value. Okay, we are the one accounting for this one using the standard. For them, they are investing 13,000. So at the end of every year, we pay them a dividend of 11% on the amount that we are receiving from them. But we are now accounting for this one using the standard. And this is how the standard says it should be accounted for. Okay, so for them, they will be receiving 11% on the 13,000 every.
1430.
Okay, so that will be 1430. So we have minus 1430. What will be the balance?
1301.
13014.
13014. So this will be the closing balance. So let's go to the preference shares there. We have to remove the preference shares under. So we come to the 11% preference share will now be treated as 13014. I hope we are okay with that. Okay. We have to go to our statement now and have finance cost. What is the finance cost? Finance cost was 1548. Okay. So we have to come and look at that later. Okay. D. D. Auntie Patria, are you there?
Yes, please, I'm here. D. Tafo Limited has a 1-year contract with one of its institutional customers, which started in June 2008. Tafo Limited, in accordance with the contract, supplies the customers a fixed of its products of 3,000 units every month at a fixed price of 200 Ghana cedis per unit. Tafo Limited, since June 2008, has been supplying the fixed quantity of its products as per the contract. However, the price of materials imported required to manufacture the company's product has increased due to shortage in materials as a result of the adverse impact of the COVID-19 pandemic and the continued depreciation of the Ghana cedis against the US dollar. The current material cost per unit is estimated at 210 Ghana cedis per unit, and the conversion cost is also estimated at 5 Ghana cedis per unit. Management is planning on discounting the supply of the goods to the customer for the remaining 8 months of the contract. The contract provides a party to give the counterparty at least 2 months' notice in terminating the contract. The penalty for terminating the contract is 8.5% of the sales or purchase value of the remaining units to be supplied or bought. The only entry made in respect of the contract is revenue and products cost for the first 4 months of the contract, included in the revenue and cost of sales figures respectively in the draft accounts.
Okay. What are they talking about here? I hope we have solved this note before.
Onerous contract.
Okay. This is onerous contract. So if there's an onerous contract, what you do is that you ask yourself, should I continue with the contract or I should terminate it? Is that a question? Okay. So you look for the additional cost that you are going to be incurring to continue with the contract and the what? And the amount that you are going to be paying if you want to terminate the contract. You go for the lower option. Okay. How much are we selling the unit to them?
200.
200 cedis.
Okay. If we want to supply them, if you want to go with a contract, what will be the total cost that we are going to be incurring?
215.
Okay, we are going to be incurring 215, but 200 will be recovered from the sale, isn't it?
Yes.
So we'll be incurring additional cost of 15 cedis to continue with the contract. So what you do is you ask yourself, so you can write the onerous contract here. Okay. And the onerous contract, the standard says that you should make a provision for the lower of the cost or the lower of the additional cost or the penalty. Okay, so let's come to the additional amounts. Okay, additional cost that we are going to be incurring. The additional cost will be the 215, which is the production cost, but this one we are going to be receiving 200 because we are going to be selling the item for 200. So 200 of the cost will be recovered through the sale. It means that we are going to be incurring additional cost of 15 cedis per unit. Okay, so if you want to continue with the contract, we are going to be incurring an amount of 15 cedis. So if you want to continue, it means that you have to put an amount aside, which is equivalent to 15 cedis of the unit that you are going to be selling or you are going to be producing to the person. Okay, let's look at the contract.
The penalty.
The contract is for a year, isn't it?
Mm-hmm.
Okay, it's a 1-year contract, but we have already supplied what?
4 months.
4 months. So remaining what?
8 months.
8 months.
Okay. How many quantity are we supplying every month?
3,000.
So for the 8 months, how many quantity will be supplied?
24 times 15.
Okay. So we have
24 times 15.
so we have the total cost of continuing the contract. So if you want to continue with the contract, that will be 3,000 multiplied by 8 multiplied by 15. Am I correct?
Yes.
Okay. That will give us how much?
360,000.
Okay. So if you want to continue with your contract, you have to incur additional cost of 360. But what if we want to terminate? What will be the penalty that we are going to be paying? Let's look at what they are saying about the penalty. Okay. The contract provides a party to give the counterparty at least 2 months notice in terminating the contract. The penalty for terminating the contract is 8.5 of the sales or the purchases value of the remaining unit to be supplied or bought. The only entry made in respect of the contract is revenue and product cost for the first 4 months of the contract included in the revenue and cost of sales figure, respectively, in the draft accounts. So the penalty, are we going to be paying the penalty on the purchases or on the revenue of the remaining amount? Yeah, it will be
Revenue.
you cannot be giving 200 cities and be saying that you want to take penalty on 215. No, we are going to fight. Okay, so let's ask ourselves, what is the revenue from the remaining item over the 8 months? That would be 24,000 multiplied by 200 Ghana cedis. Is that correct?
Yeah.
Okay, and we are paying 8%, 8.5%, so that will be 0.085. That will be the penalty. How much are we getting?
408,000.
Okay, so as a rational business person, what are you going to do? Will you continue?
You continue.
You will continue. Okay, so you have to make a provision for the
360.
Okay, so you have to know that.
They said
This
in the
divided by
month,
the
a 2 month notice.
I'm with you.
So they said if he wants to cancel the contract, he has to give a 2 month notice. So
Okay.
I was
If
thinking,
you don't give the 2 month notice, what will happen? You still pay the penalty, isn't it?
Yeah.
Yeah.
Okay. If you are working for your boss, and you want to resign. Okay. In the contract, they are saying that you have to resign. But if you want to resign, you have to give 2 months notice before you resign. But if you fail to do that, you are going to pay a penalty, isn't it?
Yeah.
So right now, if you have a job, okay, and you decide not to give the notice, you pay a penalty, isn't it?
Yeah.
Okay. But right now, it's either you give the 2 month notice and continue with the work for the 14 weeks before they find a replacement. Okay. Then you will now go. Okay, let me put it again. So your boss is saying that give 2 weeks notice. Okay. If you give a 2 weeks notice and you are able to come to work for 2 weeks, there will not be any penalty. You are not going to be breaching the contract. So there will not be any breach of the contract. You will not pay anything. Okay. But if you don't give the 2 weeks notice, you have to go and pay penalty of 100 cedis. Okay. The 2 week notice that you are going to be giving and come to work. Okay. What if the transportation that you are going to be incurring is 150? What will you do? Will you give the 2 weeks notice and be going to the work, or you just stop the work and pay the 100 cedis?
But still, you take your salary. Aside giving the two weeks notice, when you continue going, you will take the salary at the end of the 2 weeks. So
No,
it's
we are not. The assumption is that let's forget about the salary.
the salary.
Okay.
All that is being equal.
Okay.
I mean, I wanted to
All
ask
things being equal, yeah.
I wanted to ask if you are giving if you give the 2 week notice before you are going to pay the money to discontinue.
No.
I want to provide for the 2 months that you are going to still provide them before you continue discontinue the contract.
No. Okay. The contract is saying that if you want to terminate, you give 2 months notice, isn't it?
Yeah.
Okay. You give 2 months notice. Giving the 2 months notice means that you have to inform us that, okay, we are going to terminate the contract. Okay. Terminating the contract, the cost I'm going to be incurring will be higher than the amount that you are going to be paying. I cannot make that sacrifice. So the only thing I can stop supplying to, if you take me to court, the court will tell me that I should pay the 8th month that I was not able to supply. That is it. That is all. Because if I want to continue for that 2 months, I'm going to incur a lot of costs. Where will I get the money from? So the court will say that, okay, because I'm not able to supply for that 2 months, okay, they have taken money from somewhere. So what will happen is that I have to reimburse them for that particular amount, and that is a penalty. That is part of the penalty. So if I'm not giving you a notice, I will just pay penalty for the remaining one. The remaining one is a 2 month I haven't supplied together with the remaining 6 months. I'll pay penalties on that. Are you okay? So we are only going to be continuing with that if the amount will be lower than the amount of supply will be lower than the amount that you are giving to us. In that case, we don't even make any provision for whatever cost that we are going to be incurring. But if I don't give you notice, I will still pay penalty. So the penalty has been factored into that particular one. You cannot do that. You have to supply for 2 months and you incur a cost of 250 and they will pay you 200. Are you doing charity work? No. So that 2 months.
The penalty, the 2 months that you provide, you have provided for it in the penalty.
Yes.
In the 200.
Yeah, we still pay the penalty for if we can give you a notice and stop supplying immediately. We can give you the notice now and stop supplying immediately. That we cannot, looking at this, we cannot supply again. We are still going to pay the penalty to you. Okay. So we can give you the notice that it is unfortunate that we cannot give you a notice on time. So we want to stop the contract with immediate effect, or we want to cancel the contract with immediate effect. Whatever be the case, you will not just take it like that. You have to take a legal action against him, and the legal action is the penalty that will pay. So let me just provide for that penalty and stop now. All right. All right. Okay. So they will provide for the 360. So this provision, you add it to administrative expenses and you add it to your other payables, trade and other payables. Okay. So we debit our profit or loss, which will be the administrative expenses of 360, and we credit our payables because this will be incurred within 8 months. So let's come to administrative. This one is, let me say 360 here. Administrative, there is no space. Okay. Let me just take the exchange here. Okay. So let's come to provision for onerous contracts. Okay. Let's come to, so what will happen? Our payables will now increase by, trade and other payables will now increase by 360. If you want to show it as a provision also, there's no problem. Under the current liabilities, there is no issue with that. Let's count the last one. Then
E.
Yeah.
A total dividend of 4.2 million, including preference shares dividend, was paid in the year and has been charged against retained earnings. Total tax expense represents current tax for the year. The current tax for the year, after taking into consideration the above adjustment, has been re-estimated as 8.1 million Ghana cedis. Ignore the effects of any deferred tax.
Okay. So our current tax now is what? 8,100, isn't it?
Yeah.
So let's just bring it over here as 8,100 to this figure. So we can just go and put those statements together now. Okay. So revenue has not been adjusted, isn't it?
Mm-hmm.
So what is our revenue figure?
Two, 4, 5, 1, 6, 3.
245,163. Cost of sales is what?
110,323.
110,2.
323.
Okay, 323. So 323. So what will be our gross profit?
134,840.
So 134. 134
840.
840. Okay, our admin expenses. What is our admin expenses? Can we total admin expenses over here?
Okay, we are done with the admin expenses.
Yeah. Having 73673. Can I be confirmed?
Confirm.
Confirm.
Okay. 7 3. So we have 7 3 6 7 3. Hey, I've forgotten the figure. Okay.
73763.
73763.
Okay. So 7 3 7 6 3. And our distribution, there's nothing to the distribution. So what will happen? What will be the distribution figure?
24516.
24516. Okay, 24516. Okay, so our finance cost was estimated to be 1548. Okay, so what will be our profit? Profit before, so 134840 minus 73763 minus 24516 minus
35013.
okay, 35013. What is our tax expense? You can see that the actual tax is now 8,100, isn't it? So we have 26913. Okay. So let's now bring our inventory. What is the inventory figure? Nothing has happened to the inventory. What is the inventory figure in the statement? Nothing has happened.
8736.
Okay, 8763. 87.
36.
Okay. Receivables is what?
19807.
19807. Cash and bank.
29198.
29198. Stated capital.
52,000.
Okay, the retained earnings will be adjusted. Do you agree?
Yeah.
We have added the retained earnings over here is after adding the draft profits, but the actual profit should be 26913. Okay, so we come and adjust the retained earnings. But our current tax also, we have done that now. So let's come and do workings for the retained earnings. Okay, so let's come to retained earnings. I will show you. You can do this in too many ways. What is the as per statement? What is the retained earnings as per the statement?
There's not going to be any adjustment on the tax.
On the tax, we have shown, we have reported the actual figure already.
But there's a footnote there for it all.
Yeah, we just sent the actual figures there. So
In the footnote.
8,100,
Okay.
yeah. So at 8,100 for current tax, and the profit or loss, we bring the 8,100. So it means that we have taken the actual current tax. But you can also bring the tax itself and subtract to get the 8,100. There's no problem with it. Okay. So what is the retained earnings as per statement?
36109.
So 36109. Okay. Look at the last footnote. They are saying something there. That a total dividend of 4.2 million, including preference shares dividends, was paid in the year and has been charged against retained earnings. So it means that we have taken all the 4,200 from the retained earnings. Is that the case? Is that the case for the retained earnings? Dividend of 4,200 has been chart to statement of changes in equity. Is that okay?
Yes.
Okay. Which type of dividends should be taken to statement of changes in equity?
Ordinary shares.
Okay. So it means that preference dividend should not be taken. We have to come and add it back. Okay. How do we do the preference dividend? It is just the amount paid, the coupon, multiplied by 13,000. So that will give us 1430. That has been subtracted. It should not be subtracted. Okay. What was the profit added to get a retained earnings? It was a draft profit. Okay. The profit added to get a retained earnings was a draft profit of how much?
27,581.
The profit added to
27,581.
okay. The profit added to get the retained earnings reported over there is
581.
But what is the actual profit?
26,913.
26,913.
So how much was added in excess?
$668.
Okay. So profits overestimated. Okay. Profits overestimated is how much?
668.
So 668. That should be adjusted by subtracting. So you can get your this one now plus 1430 minus 68. I'm getting 36871. Okay. We are going to calculate the retained earnings in another way too. Okay. We also know that the retained earnings reported over there is the opening retained earnings plus the profit after tax for the year minus the dividend is equal to the 36109. Is that correct? The closing retained earnings reported in the statement of financial position, it is calculated as the opening retained earnings at the start of the year plus the profit for the year minus the dividend subtracted. Then we get a closing balance, isn't it? Okay.
Yes.
So you can calculate the opening retained earnings and now do the actual thing. So this will be calculated as opening is equal to 36,109 minus the profit after tax plus the dividend.
Minus dividend.
Okay. So we have 36,109. What was the profit chart to get the closing? That was 27 something.
Is it the one the drafted one?
Yeah, the drafted one is the one that they used to get this one. So this is a return.
27581.
Okay. 27.
Okay, 27581.
Okay. 27581. Okay, 581. And the dividend that was subtracted was 4,200. Is that right? The dividend that was subtracted was 4,200. The dividend chart
4,200.
retained is so 36,109 minus 27,581 plus 4,200. I'm getting opening retained earnings of 9728.
Please, where did you get your 4,200?
In the statement. Footnotes.
Oh, okay. Okay.
So I'm getting opening retained earnings of that. So you can now do your new retained earnings. The actual retained earnings having the balance go down to be 9728. Then you now add your actual profits for the year, which you have calculated now. Profit after tax to be 26913. So 26,913. Then you now subtract equity dividends. So equity dividend will be 4,200 minus 1430.
Linus, I don't know. I think I'm waiting for someone to confirm your opening balance there. I don't think it's
Okay,
correct.
36109 minus 27581 plus 4,200. Okay,
Yeah.
12,728.
Yes.
Okay.
It's for something.
No, it's
423.
4328. It's supposed to be 4328.
No, the dividend is an additional.
So when you add the dividend to the,
127.
it will be 31,000
No,
something.
this is negative plus, so it will reduce. They are not negative. If they are negative, that's why you have the 31. So this will be negative 2758. The negative is affecting it. The 27 is the one carrying the negative. So this will be negative 27,581 plus 4,200. Or
4,000 is not positive.
4,728.
Is that?
4,000 is positive, right?
4,200 is positive. So 36,109 minus 27,581 plus 4,200. You'll be getting
12,728.
728. All right. Okay, so plus 2691 minus your 2270. Okay.
37,371.
Then it means that the figure that you have mentioned over here. Okay, this is supposed to be 2770. Okay. This is 2770. 4,200 minus the dividends. Okay, that is 2770. Okay, so you can now subtract 12,728 minus 26,913 minus 2770. Okay, so 36,87. Okay, it depends on how you understand it. So if you can get understanding of the first one, fine. If you don't get understanding of the first one, then you can find your opening return earnings and now do the right thing. Now add the actual profits, then you subtract the equity dividend from that. So your return earnings will now be 368,871. So return earnings will be 368.
871.
Yeah. 36871. All right. So your trade and other payables, just put this one together, and that is the end. Okay, at least we have done the final account now. I've fulfilled my promise of solving 2 questions. Please, let's pick at least let's pick like 2 standards, 2 different standards, and see if we can do something about it.
Oh, okay. Please, so with the rest of the figures in the draft statement,
Yeah.
you just copy them back.
Yes, if they are not going to be affected, we just pick them. That's all.
Okay.
Auntie Patria, are you there?
Where is our overstatement coming from?
Is the profit that was added? The profit that was
No,
added.
I want the actual figures before I will do my own movement.
The actual figure is 27,581 minus.
As per the statement.
Yes, please. Then minus the actual profit that's supposed to be added, which is 26.
The one we recorded when we.
The actual one that we have determined.
Yeah, the one we determined.
Yeah, 26,913.
Okay.
Okay.
27,5 each one.
Yeah, minus 26,913. Okay. Auntie Patria, are you gone or you are still there?
Please, I'm here.
Why is your voice down? Your voice was up.
Hungry.
Okay, let's solve two questions. Let's solve leases and impairment so that we can do the rest are done. Okay, we can try the rest are done. So let's pick the two questions on them. The first question on leases, the second question on leases, the third question on impairments, and the fourth question on impairment. Then the earnings per share and the rest we can look at them, maybe glance through them and see. So let's pick at least two standards so that it will not be, we not have too much load to cover.
Please add the revenue to it.
The revenue is plenty, so let me do that one tomorrow. Okay. So I have revenue investment property also. For you, they can bring the minor standards anyhow. So let's come to. Okay, first question on leases.
Okay, question 1. On 1st July 2010, Masco PLC began to lease a plant under a 5-year lease. The economic life of the property has been estimated at 8 years. The lease rental paid by Jumaso were 5 million payable annually on 30th June. At the end of the lease term, Jumaso has an option to purchase the plant for 10 million, which is expected to be 15% below its prevailing fair value at the exercise date. On 1st July 2010, Jumaso incurred direct costs of 1.2 million Ghana cedis in concluding the lease, and on 30th June 2011, Jumaso made the first rental payment. At 30th June 2011, the end of lease purchase exercise price has been revised. An applicable discount rate is 8% required. In line with IFRS 16 leases, prepare extract of the financial statement of Jumaso for the year ended 30th June 2011.
Okay, thank you. So this is just a normal lease question. This is just a normal lease question. So this is just a normal lease question. Okay, this is a finance lease, isn't it? Because the useful life is 8 years and we are leasing for majority of the useful life, which is 5 years. Okay. How are we paying the rentals? In arrears or?
Yes.
Okay. We are paying the rentals on arrears. They say that they have the option to purchase. Please, you can't just stand up and say you are including the option. If you have the option, no matter what the amount, the question is, are you people convinced that you are going to be what? Exercising the option? We only include the option when we are determining the lease liability, when the entity is certain at the inception of the lease that they are going to be what? They are going to be exercising the option. So what they are trying to give you the option is also telling you that this is a finance lease. Because a finance lease, we always have the option to purchase. Okay, so the option of 10 million, please ignore it because there is no evidence that the entity is going to be what? Is going to be exercising the option. Although the question is saying that it's 15% below the market value. It can be 5 CD, but do we have the capacity to purchase the what? The item? Do we have the money or are we convinced? Do we have everything to purchase it? It can be 10 CD, but at the end of the lease period, we don't need the asset again, so we cannot exercise the option. So the option, you only include the option when the question is saying that it is certain that the option will be what? Will be exercised at the what? At the inception of the lease. So what we do over here is that we are coming to calculate our lease liability, and that will be, we can use annuity for that. Very simple. So we have our IFRS what? 16. IFRS 16. That will be leases. Okay, so let's have the initial recognition. So you can write more English. Okay, at inception of the lease, the company Jomosu should initially recognize the what? Should initially recognize the lease liability and also a corresponding right of use. Okay, so but
No class, my man from
we are not here to do that. So let's do initial recognition. Okay, the initial recognition will be create your lease liability, and you create a corresponding right of use. So let's do the lease liability. So what we do over here is that we can calculate the lease liability straightforward. Okay, we don't have to do the years again. But if you like, you can do the years and do one, but for me, there's no problem with that. So let's come. How much are we paying every year, at the end of every year?
$5 million.
5 million.
Okay, so 5 million. The lease period is 5 years, isn't it?
Yeah.
Okay, and we are paying 5 million every year. So that is an annuity, 8%. The applicable discount
For
rate.
many years? 5 years.
Okay, please, sometimes they will not give you the rate that you have to use is the rate of interest implicit in the lease. But if that is not available, you use the borrowing rate of the what? Of the leasing. Okay, so they can tell you that, okay, the rate of implicit is not readily available, and the borrowing rate of the company or the Jamasu is 8% or something. But if you are giving the two, use the rate implicit in the list. Okay, but this one they are giving us applicable discount rate to be 8%. So annuity, 5 years, 8%. What are we having?
3.993.
Okay, 3.993. If you multiply, what are we having?
$19.965.
Okay, 19.965. Okay, so right of use, what will be our right of use? It will be the lease liability. Okay, assuming we have cash to pay, this is the cash amount of the asset. So if you have money to pay now, you pay this amount for the asset, which is 19.965. That is the value of the asset. Were there any direct costs? Were there any direct costs incurred?
No.
Are you sure? On
There
1st
is.
July 2010,
1.2.
Yeah, direct cost, yes, of 1.2 million.
Direct costs can be installation costs, it can be delivery costs. So just that will be added to the amount of. So if we have money to pay for the asset, this is what we are going to be paying. So it means that this is the value of the asset as of today. But we incur a cost to bring the asset to the state that it will be ready for use. So that cost must be added to the initial cost of the asset, 1.2. I'm having 21.165. Okay. Let's come to the subsequent measurement, which will be at the end of the year. Yeah, Auntie Elizabeth, I saw the hand up.
Yes, sir. So, like the purchase, if it was certain that the option was to be exercised.
Then we
So-
present value the option too.
Okay. After that, will we add it to the lease liability or the
Yeah,
right of use?
it will be added to the lease liability, which will also be form part of the right of use.
Okay.
Yeah.
So go over again. When we
have the option to purchase. Okay. So if you have the
is it the option figure we are present valuing?
Yeah, you have the option will be you are going to be purchasing the asset at the end of the
At the cost.
At the end of the 5 years.
Okay, so you discount that and add it to the liability.
Liability and also the right of use. It will
The
always
right of use.
Yeah.
Okay, let me ask this. What of if, like you were saying, if you were to have a physical cash, you would have paid 19965.
Yeah.
So in that case, you don't have any issue with liability again.
If you have the money to pay, it means that you are not going
It
to
will be between cash and the right of use.
exactly, or you are
So
purchasing
you
the
just
asset outright.
so you just discount your right of use and then throw it to
No,
is it amortization?
if you have cash, it will not be a lease again. It means that you are purchasing the asset from the person. But if you still have
But
cash,
you can still have the right of use in your book and then amortize over the time. Because it's not for one time.
the asset will still be recognized, but it will be depreciated. So you will not expense the amount, the asset.
Yeah, that's what I mean.
Okay.
That's what I mean.
Okay. But if it is still a lease, if it is a lease, okay, the lease is coming with an agreement. So the lease will be coming with an agreement. But what we are going to be doing is that you can pay the 5 million multiplied by 5. The entity can pay.
I'm not getting your option.
Okay.
The option when there's a agreement that you will extend the period over what you've already paid for or what you are here to pay.
Yes, or you can even have the option to purchase the asset at the end of the
okay.
like that will still be at that particular date. Okay. So you just find the fair value of the okay. Let's count the subsequent measurements. The lease liability will be amortized. So lease liability will be amortized. So we have our balance at the start of the year. That will be 19.965. Then we have the interest, which is the finance cost, 0.08 multiplied by 19.965. What are we having? What are we having?
1.5972.
Okay. So let's make it 1. Would that be 1.60 to 3 decimal places? Okay,
Yeah,
that would be 1. Okay, that would be 1.597, 3 decimal places. Okay.
But we have some thousands, Bio.
So these are all in million. Okay, we are doing all this in million.
Oh, okay.
We are doing this all in million. Okay, so let's make it 1.597. The renters, how much are we paying? We are going to be paying 5 million at the end of this one. So what will be the amounts? 19.965 minus 5 million. I'm having 16.562.
562. Yeah.
Okay. Okay, you can separate this. I hope we know how to separate it, isn't it? So we can have the current liability of this.
The 5 is 5.00, right?
Yes.
Yeah. Rental is 5.00. Okay.
Let's just write 5,000.
So we should change it to, okay, let's keep 3 zeros. Okay. So let's multiply this by, this will be 19,965. Okay, 19,965. And this will be
1597.
Okay. So let's have 1597. So this will be 5,000. So let's have the 5,000. Okay. And that will be
16,562.
Okay. So let's separate that, the current liability and the non-current liability in the statement of financial position. Okay. So let's find what will be the interest that we are going to be paying next year. So the interest minus the whole amount, that will be 0.068 multiplied by 16,562. Okay.
Ouch.
Hey.
What bread?
Okay. So how much are we getting? The interest that we should be paying next year, the interest will be paid on the opening balance, which is the closing balance for now. Okay, that will be 16,562. Okay, minus 5,000.
3675.04.
Okay, 3675. Okay, so our non-current component will be 165,562. Please, the liability is still the same as this one, but 3675 out of this will be for current. So the remaining will be 3675. Okay, what are we having?
12886.96.
Okay, 12887. Okay, let's come to our right of use. What will happen? We depreciate the right of use. Okay, so the right of use will be depreciated. So we have depreciation of the right of use. That will be calculated as 21,165 divided by 5 years. What are we having as the depreciation? I'm having
4233.
Okay, 4233. Okay, so they say we should show extra. So statement of profit or loss. We have depreciation of 4233. 4233. Then we have finance cost.
The useful life is 5 years, right?
Yes, please. Okay. We have 1597. Let's come to statement of financial position. We have the right of use as an asset. That will be 21,165 minus 42,300. Then this will be assets. Then we come to current liability. Current liability, we have lease liability. Under the current liability should be 3675. Non-current liability under the lease will be what? 12887. Oh, so all right, so that is that. There is nothing that you have to do again. Please let's take the sales and lease back. Okay. Question number 2.
Question 2.
Yeah.
Mamponti PLC entered into a sale and lease back on 1st April 2017. It sold a lot with a carrying amount of 300,000 Ghana cedis for 400,000 Ghana cedis, equivalent to fair value, and leased it back over a 5-year period, equivalent to its remaining useful life. The transaction constitutes a sale in accordance with IFRS 15. The lease provided for 5-year annual payments in arrears of 90,000 Ghana cedis. The rate of interest implicit in the lease is 5%. The cumulative value of 1 Ghana cedis in 5 years' time is 4.329 Ghana cedis. Required. What is the amount to be recognized in the financial statement at 31st March 2018 in respect to this transaction?
Okay, this is sales and lease back, isn't it? Okay, whenever there is a sales and lease back, you ask yourself, does a transaction constitute what? A sale? If the transaction constitutes a sale, does possession and ownership of the asset transfer to what? To the buyer? If that is the case, then the owner has to de-recognize the what? The asset. So this is actually a sale. So Mampontin has to de-recognize the asset from their books. But there are times that the sale will be at a value higher than the fair value. Okay, so maybe the entity can sell the asset for 500,000. Okay, but the fair value of the asset will be what? Will be 400,000. Whatever be the case, the asset should be sold at its fair value. So you should sell the asset at 400,000, but you are now selling it at 500,000. It means that the company is giving an additional loan of 100,000. I hope we can remember this.
Yeah.
Okay. I hope we can remember this. The time that we are doing leases, where
Yeah.
there will be additional finance component that will be accounted for as a financial liability and a financial instrument. So we even saw example on that. And we even saw example where the asset can be sold at 355,000, but the fair value will be what? Will be 400,000. It means that we take the 50,000 as an advance what? Payment. That will be added to the right of use. We also solve a question like that. Okay. So if you are not part, you can check our YouTube channel on sell and lease back. You see a question there. Okay. So what we have to do is that since this is a sell, the asset has to be removed from our books. Okay. If the asset has to be removed from our books, it means that we are going to be transferring portion of the right to the what? To the buyer, who is now the what? The lessor, and we're also going to be retaining a portion of the asset. So we need to find what we call the right of use. Okay, so we need to find what we call the right of use. The right of use of this asset is calculated as the present value of the lease payments, present value of the lease payments divided by the fair value multiplied by the carrying value. Okay, so what is happening is that we are retaining the lease liability is the portion that we are what? We are currently what? Retaining now. Okay, but we are giving a carrying value. So what portion of the carrying value are we retaining? So the present value of the minimum lease payment is the same as how we calculate the lease liability. So how much is the company paying under the lease? What is the lease that they are paying? The lease provided for 5 annual payments in arrears of 90,000. So our rental payment is 90,000. So you bring the 90,000 multiplied by the annuity factor, which is given to you. The value given to you over there is annuity factor. If you like, you can check 5% for 5 years. If you'll be getting a 4.329 divided by the fair value of 400,000 multiplied by the carrying value of what? 300,000. Okay, so the top is what? I'm having 389,611.
89.61.
Okay, divided by 400,000 multiplied by 300,000. What is the right of use?
292207.5.
Okay. So we are having
2207.5.
207.5. So that will be our right of use that we are going to be recognizing. Okay, so we need to calculate profit on the sale now. Okay, so we have a right of use of that. We are also going to be having a lease liability of this. The lease liability will be 389,160. That is the amount that we are going to be paying the people, the present value of the amount that we are paying them. Okay, now we are doing this. We need to calculate as a profit on the sale. Okay, so the profit is calculated like this. Okay, profit is calculated as the carrying value of the asset minus the right of use divided by the carrying value multiplied by the profit that is recognized on the sale, which is if the asset is not leased back, what would have been the profit? That is so you are retaining the carrying value of the asset is 300,000. You are retaining 292,207.5. So what portion of the carrying value are you giving to what? To the buyer, who is not the lessor. So we have the 300,000 minus 29,22,29,22,70.5 divided by 300,000 multiplied by the profit that you are making on the sale, which is 100,000. How do we get 100,000? The 100,000 is calculated as the fair value. We are selling the asset for 400,000 and the carrying value is 300,000, which is
My from my class.
okay. That is autumn. Okay, thank you. All right. So the profit is the carrying value and the amount that we are receiving, or the fair value, which is the profit. Assuming we are not leasing the asset back, this is the profit that we should be making on the asset, which is 100,000. But we are retaining, out of this 300,000, we are retaining a portion back. If we should transfer all the 300,000 to the buyer, it means that we are going to be getting a profit of 100,000, but we are retaining almost this figure. This is the portion of the asset that we are going to be using. So we are retaining 292,207.5 out of the 300,000. So what is the portion that we are transferring to the buyer, who is not the lessor? That's how we do it. So what will be the profit on this transaction?
2597.5. 97.5.
Okay, 2597.5. Okay. That is how we calculate the profits. But you can also calculate the profits like this. What are the entries that you have to pass for this transaction? The first one is you are going to be debiting the cash that you received of 400,000. That is the first entry. You now debit right of use of the assets, which is 292270.5. Okay. Then another entries that you'll be passing is that you are going to be derecognizing the assets. So you credit the asset with a carrying value. You have to remove the asset from your books. Okay. Then you also have a lease liability relating to these assets. So you now do the entries for the lease liability, which is 389,610. Okay. What will be the total for asset? What will be the total for the debits? And what will be the total for the credits?
The debit will give you 692,207.5.
Okay, what about the credits?
689,610.
What is the difference?
Six, 9, 2, 2, this one minus 689,610. 2597.5.
Okay, so you can also find a profit by passing the necessary entries that you can pass based on the transaction. Okay, this is the only side of the sale and lease back. You only have to calculate the right of use and also the profit on the transaction. Apart from that, the calculation, the lease is accounted for like the normal lease, where you have to depreciate your right of use, which will be the subsequent one, depreciation of the right of use. So we have to find a depreciation of the right of use. So the right of use is now equal to 292207.5 divided by 5 years. What will be the depreciation?
58441.5.
Okay, 58441.5. So that will be the depreciation. Then the lease liability must be amortized like normal liability. So the only thing about a sell and lease back is to determine the right of use. How do you determine the right of use? The present value of the lease payment divided by the fair value multiplied by the carrying value of the asset at the time of the sale. So this will be, we have at start, the lease liability at start, that will be 389,610. Then we have the finance cost. The finance cost of 0. What is the interest figure?
8.
Okay, 0.8 multiplied by 389,610, and you pay the renters at the end of the year, which will be 90,000. Okay.
The finance cost will be 31168.8.
31168.8.
168.8.
Okay.
6311. Is that not it?
It's supposed to 311, isn't it?
31168.8.
So 31168.8. So at the end of the year, we pay the renters. The renters are paid in arrears. So at the end of that year, we pay the renters. So 389,610 minus 90,000. I'm having
0778.8.
0778.8. So that will be your lease liability. If you like, you can split it. Your statement of profit or loss, you show your depreciation, you show your finance cost, then you show your profit on disposal, which will be 2597.5. So that is the only thing about this. I know we are tired. Let's take the, okay, I will come and solve the question 3 and done. Let's solve the question number 4, which is very simple for us to do.
Please, get to the worksheet. Let me see something. Okay, thank you.
All right. Auntie Patrick, question number 4.
Question. A cash generating unit comprises of the following assets: building, plant and equipment, goodwill, current assets. One of the machines carried at 40,000 Ghana cedis is damaged and will have to be scrapped. The recoverable amount of the cash generating unit is estimated at 750,000 Ghana cedis. Required. Compute the impairment loss to be charged to profit or loss for the year. What will be the current amount of the assets when the impairment loss has been recognized to the nearest thousands?
Okay, so this is what? This is a cash generating unit. What is the carrying value of the cash generating unit?
1,010.
Okay, so what is the recoverable amount?
750,000.
750.
So what will be the impairment?
Big.
The carrying value will be 110. Recoverable amounts will be 750. Okay. So the
260.
Okay. So we have impairment loss of.
So that's question hot.
Question number 4. So we have 10 minus 750. That will give us what? 260, isn't it? Okay. How do we share impairment loss under cash generating units?
Goodwill is written off.
Okay. Share of impairment, share of the loss. Okay. Let's go there. Okay. They are saying that one of the machine is, so the physically damaged asset should be the first one, isn't it?
Yeah.
So
40,000. Okay.
one of the machine is damaged, and that will be taking 40 of it, isn't it?
Yes, 40,000.
Okay. So goodwill, if after taking 40, we are going to be having 220, isn't it?
Yes.
Okay. So the 220, we now give goodwill how much? Goodwill is how much? Goodwill is how much? 90. Okay. After the goodwill is taking 90, what will be the difference?
130.
Okay. This 130 now, what will happen? It will be
Pro rata.
okay. Please,
Prorated.
most at times, the current assets are assumed to be at their what? At their recoverable amounts. Okay.
So we don't touch it.
We don't touch it. Let's come to, so that particular now will now be what? What will be the remaining value of the building? What will be the remaining value?
990.
Okay.
How goodwill is there?
Okay. Let me pick that one again. Let's say the machine carried at 40. So what will be the remaining value of the machine?
Plant and equipment should be left at 160.
160. Okay. Then what will be the building will still be 700, isn't it?
Yes, sir.
Yes.
Okay.
Goodwill is gone.
Goodwill is gone. So this will be dashed, and this will still be 20, isn't it?
20. Yes.
Okay. Yes. This, if you make this assumption, you are not going to be wrong. Okay. You can say that the only machine that was impaired is the one that has been damaged. So it means that the remaining machine at 160, they are not going to be damaged. There's no problem with that. If you are making that assumption, then it means that the 130 will be given to only building. Okay. Okay, so let me count with the share of the impairment again. So the share impairment, we're having
all the informations are gone.
Yeah. So we have
from when we started.
Yeah. But I'll get a board for you. But just I cannot show that one right now.
Oh, okay.
Okay. So machine is taking 40, isn't it?
Yes.
Yes.
So goodwill will be taking 90.
90.
We are left with 130, isn't it? Okay.
Yes.
And I'm saying this one. Okay. You can see that one of the machines, okay, plant and equipment. So one of the machines carry at 40,000 is damaged and will have to be scrapped. Okay. You can say that the only item that is impaired in the plant and equipment, the only item that is impaired in the plant and equipment is the one that is a 40. So it means that the remaining will be 160, which has not impaired. And you take all the 130 to building and say, okay, that is relating to the building. There's no problem with that one. Okay. So you can bring the building over here to be 130 and you have your 260. Okay. Someone can also do this. Okay. Someone can say that, okay, we have a machine of 40, then goodwill will be taking 90. Then the remaining 130 now, it means that, okay, there are some of the plant and machinery which are impairing again. So it means that the impairment will be shared amount 160 and what 700. So you now have 860. So you still have plant and equipment here that, okay, the remaining value are still what? Impairing. There's no problem with that one also. Okay. So you have 160 divided by 700.
860.
860.
860.
All right.
860 times 130.
Multiplied by 130.
You have 105,
Okay.
106.
So we have, yeah, that is too much.
105.8.
160 divided by 860 multiplied by 130. I'm having 24.
24?
Yeah.
Okay, I did 700. That's for the building.
Okay. So this will be 24. Okay. Then you come to the building and do 700 over 860 multiplied by 130. So yeah, Sina, you can mention your one now. That will be 106.
106.
Okay. So this will still be 260. Okay. Then you can show your carrying value after the impairment. Okay. So the carrying value after the impairment, we are going to be having building. So we use the two options. So the building will be 700 minus 130 if you are using the first one. Okay. And that will be 570. Okay. Plant and equipment be 200 minus 40. That will be 160. Then you now have current assets of 20. Okay, then you need to have 750 as the current amount. Okay, if you are showing the current amount under the second one, then another second option is that, okay, further plant and equipment has impaired. Then we have our building to be 700 minus 106. That will give us.
You made 106. I thought it was 105.
We are doing
okay
24. So if we add a 2, we need to get a 130.
Okay, so it will be 594.
Okay, 594. Then our plant and equipment will be 200 minus 40 minus 24.
That'll be 136.
Okay, that will be 136. Then we have our current asset to be
20.
All right. So that is it. That is it for that. But the first question, I need to put corporate reporting people their standard questions together before I meet them. So we have to end it over here for now. Okay, tomorrow dawn we'll continue with the rest of the standards. Okay.
Okay, please, I have a question.
Yeah.
I went off. The building, how did you get at 130?
But is the remaining of the impairment. The impairment is 260. Machine is taking 40. Goodwill is taking 90. The remaining is good. The remaining will be the building. If we are assuming that no plant and equipment has impaired apart from the machine of 40. So the remaining of the impairment will be given to the building, which is 130.
I still don't get it.
Is that okay? But you got the 260, isn't it? The impairment.
No, when I came back, you had done that one, so I'm even confused. But I know the 260, when you add the few of them, you get a 260.
Oh, really? Okay.
Yes, but then with the 130.
All right.
Yeah, we've closed. So
the carrying value is what? The carrying value of the asset is what?
1,010.
Okay, what is the recoverable amount?
750.
Okay, so Whenever the carrying value is higher than the recoverable amount, the difference is what we call the impairment. So find the difference.
260.
Okay. So the 260, they are saying that one of the machines carried at 40 is damaged and we have to be scrapped. So it means that the 260 over here is as a result of a value over here is as a result of the machine being what written off. So we have to come and take 40 from the machine. So it means that the machine is going to reduce by 40. So
40.
it means that 40 is included here. We take it out. Okay. So the physically damaged assets have to be written off. That's why we share impairment of a cash generating unit. The cash generating unit can be like a store that you have, that all the assets must come together to generate a cash flow. Okay. So the 40 will go. Then goodwill will be written off. Okay. So we write a goodwill off as 90. What will be the remaining amount?
130.
Okay. So we are saying that we can assume that the only item that is impairing under plant and equipment is only the one that is being scrapped off, which is 40. So it means that the remaining 130 has to be a reduction in the building so that we get a 260. Okay.
Okay.
All right. I hope you are okay with the 130 now.
Yes, please. Thank
Okay.
you.
All right. All right. You're welcome. All right, seniors, any question? I want to.
You've done well. All the best.
All right, senior. If there are no questions, then
I will cross you on my listening.
okay. All right.
Yeah.
All right.